deep cuts, right? We're talking about the typical culling of the herd.
8% of the workforce, I would say, is relatively deep.
It's not just the typical culling of the herd, but it does come off a pretty high base. Coming up, you have wonderful conversations. Washbat Miller on The Open. This is Bloomberg.
Keeping you up to date with news from around the world with The First Word, I'm Lisa Mateo. Thousands of stranded flyers in the U.S. who are booked on Southwest Airlines may get some relief soon. So far, the carrier has canceled just over 3 dozen flights for Friday. More than 2,300 have been canceled today, about 58% of Southwest's schedule. The airline is trying to recover from disruption caused by winter storms and outdated scheduling technology. Well, Russia is ruling out peace talks with Ukraine and says it won't give up despite setbacks in the battlefield. Foreign Minister Sergei Lavrov also told a state-run news service the Kremlin will not discuss Ukraine's demands that it withdraw from occupied lands and pay reparations. The war is now in its 11th month. China says it's up to the U.S. to take steps toward resuming military talks that were suspended after Nancy Pelosi visited Taiwan. At a briefing in Beijing, a spokesman with the country's defense ministry said the U.S. can expect discussions to continue while constantly harming China's interests. Tensions remain as Washington supports Taiwan militarily, and Beijing has pledged to bring the island under its control. Meanwhile, Taiwan semiconductor manufacturing has kicked off mass production of next-generation chips. That ensures the island remains a center of a critical technology that's fought over by the U.S. and China. TSMC is the primary chip maker for Apple. And Disney's Avatar sequel has now gone over $1 billion in worldwide ticket sales after 2 weeks in theaters. Avatar: The Way of Water is one of the most expensive movies ever made. Director James Cameron says that it needs to take in $2 billion at the box office to break even. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
We also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Daybreak with Lisa.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close. Welcome to Bloomberg Crypto.
What we're getting to is a more normal environment where we're likely to see the Fed ease what has been a dramatic level of tightening. We're likely to see inflation continue to moderate significantly in 2023. So something of a return to normal. It's not going to be an easy transition, but I suspect that 2023 is going to be a lot more normal than the last 3 years.
Christina Hooper, Invesco Chief Global Market Strategist, speaking on the expected path of inflation at a time of incredible uncertainty. I want to get right to our next guest. It's Lisa Abramowitz and Kaylee Lyons. Tom Keene and Jonathan Farrow are both off on a well-deserved break. Matt Miller off to enjoy the 9 a.m. hour on television. This next guest is one of the smartest minds on markets, but also the most experienced with both the private and public sector, having just come from the Council of Economic Advisors to President Biden. Dalip Singh, who is now currently the chief global economist at PGIM, also former deputy national security advisor for international economics for the Biden administration. Dalip, I want to start with this question around increasing protectionism. I will get into some of your expectations for inflation, et cetera. But this idea of the Inflation Reduction Act and what we're hearing out of Europe this morning of potentially trying to entice technology companies to come to their own shores. Do you think that this could ignite some sort of increasing reglobalization or deglobalization that we already see in effect?
Good morning, Lisa. Well, let's step back and consider the global backdrop. We're in probably the most intense period of great power competition since World War II. And it's in that context, with repeated supply shocks, COVID, but also the war in Ukraine, that major economies are saying for critical goods like semiconductors, like pharma, for electric vehicle batteries as well, and some of the foundational technologies like AI and biotech and robotics, that we want to have more prioritization on resilience and more supply chains geared around geopolitical alliances, rather than just global efficiency and rather than just prioritizing low inventories. So I think the reorientation of supply chains, it's real for critical goods and foundational technologies, but there are ways for the U.S. and its allies, particularly in Europe, to cooperate in terms of getting resilience against a shared set of shocks that worry us, using a similar set of tools, and then ultimately, since this is a multiplayer repeated game, taking actions that leave both the U.S., Europe, and our allies better off.
There's a political aspect of this, Dalip, but there's also the economic ramifications of this in terms of higher costs. Can you dovetail your view on how the West will deal with this, how the East will deal with this, and how this really affects your inflation outlook?
Yeah, so there's a negative branch of the probability tree in which this kind of supply chain reorientation leads to more frictions, lower economies of scale, lower productivity, and as you just suggested, higher costs. But there's a positive branch as well, which involves a race to the top. So that would mean more public investment, more indigenous innovation, more development of our respective labor forces, and higher growth potential, higher productivity, and diffusion of those gains broadly. That is the question that's now playing out before us. The U.S., as you mentioned, in the Inflation Reduction Act, is taking steps to bolster our own growth capacity. Europe is doing the same. And we have to manage this process very carefully and also consider how China and other countries that may not share our same objectives play their cards. And this is going to take years to play out. And I think as economists, I am putting my bet that this is ultimately going to lead to a net higher trend level of inflation and a lower trend level of growth. But I say that with relatively low confidence because these are early days.
Well, which raises a question about your fundamental belief that central banks will exercise restraint, that they won't raise rates as much as perhaps they say they will, simply because they don't want a hard landing. Can they do that in the face of some of these structural inflationary aspects that seem to be present, and a lot of people seem to be acknowledging that?
They have to. I mean, they have to acknowledge that we're living in a world of repeated and profound supply shocks, from the intensification of great power competition, which means more use of economic statecraft, from a very bumpy transition from fossil fuels to renewables, from this supply chain reorientation that we're talking about, and from less diffusion of technology. In that context, they are fighting the battle of their professional lives to maintain their credibility on fighting inflation. And so they have no choice but to execute on their mandate. That's what we're seeing, and I think it will ultimately lead to an over-tightening by central banks in a context of repeated supply shocks and thinning cyclical buffers. So I expect a bumpy road ahead.
But there's the over-tightening risk. relative to the under-tightening risk in allowing inflation to run too hot for too long and damaging the economy in that way. Is a recession necessary to get the job done?
Well, look, central banks are doing what they can in this context, and we have a labor market imbalance in this country. Unfortunately, labor supply is not coming back as fast as any of us would like. Labor force participation rates are about 1% or 2% below the pre-pandemic level. We're seeing a fall in net immigration, and so the Fed feels as though all it can do to cool services prices ex rents is to slow down labor demand and to get nominal wage growth back in the 3.5% territory, which, if you assume 1.5% productivity, would be consistent with a 2% target. Now, if you're just, the risk is this: if you're just relying on the spot inflation data to guide how much further tightening is necessary, you're likely to do too much, because we're talking about more central banks tightening faster than we've ever seen in modern economic history. And because of the spillovers and because of the lags, this is not a process that's likely to end well.
As you were just discussing kind of structural issues that are going to keep inflation more elevated, should the Federal Reserve be thinking more seriously about not targeting 2%? Is that too low for the world we live in now?
Well, the problem is you cannot change the goalpost when you haven't won the game. And so changing the inflation target from 2% to 3% when you haven't achieved your objective would be a serious risk to the Fed's credibility. But I think de facto, if we get to a core inflation level of, let's say, below 3%, and if that decline in inflation is driven mostly by cyclical factors, in other words, the Fed has done what it can, then I think the Fed could probably accept a higher level of inflation as a way of making up for decades of missing the inflation target to the downside. I don't think they would announce this officially, but I think in a practical sense, that's where we'll probably end up.
Dahlia, how does gasoline and crude prices factor into your expectations for next year and the fact that it's going to be a bumpy ride, given that we've seen an incredible rally, or at least if you look at it from the other side, we've seen an incredible decline in oil prices and gasoline prices. But next year, not only will China come back online, but the U.S. is planning to start refilling their strategic petroleum reserve. How does that sort of factor in to what you see transpiring in 2023?
Yeah, I think it's dangerous to extrapolate too far what we've seen over the past 3 months in terms of the decline of energy prices. Look, we don't know how the war in Ukraine is going to play out. We don't know what kind of supply shocks are still in store from Russia. We don't know how OPEC Plus is going to handle its own production of energy. We don't know how the competition for a finite level of LNG globally will also play out between Europe, Japan, Korea, and now you mentioned China. And so I think there are two-sided risks in the energy market. And as a consequence, this is yet another potential headache for the Fed to have to contend with as it tries to get inflation back to target. I would not assume that the only component of inflation that we have to worry about is services prices ex rents. I think food and energy prices are still very much a prominent risk going into next year.
Dahlia Singh of PGIM, thank you so much and congratulations on the new job. A really interesting point to sort of end there, Kaylee, this question about how oil prices are going to factor in, considering that we've kind of discussed how this is going to be a narrow line down in terms of inflation.
Yeah, and it raises the China question for me as well as a kind of persistent inflationary risk. You aren't yet seeing it show up in oil markets, but in theory, when that demand really does revive, that is going to fuel it, as well as the ongoing conflict in Ukraine. You had Russia saying today that they are not interested in peace talks. The idea that this is going to be just perpetual conflict, we know the effect that it has had already on food prices and on energy prices. If you still have these issues in play, it does present longer-term upside risk, perhaps more structurally changed inflation dynamics on the food and energy front.
Also, you have to think that if the U.S. is going to be buying back barrels of oil at a time when you have people still traveling around, you have all these conflicts still going on, and that was one of the big drivers of the decline in prices. You do have to wonder how far that will go, or whether perhaps there just is a destruction in demand. Coming up on Balance of Power on Bloomberg Television and Radio, Angela Stent, Senior Fellow at the Brookings Institution, brilliant always on Russia and Ukraine as that conflict continues to grind on. From New York, this is Bloomberg.
The top names times in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
You've been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning, and therefore the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return, and to get a long-term return, putting it into private hands is one way of doing it, but really the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is U.S. public sector owned, that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York City for our viewers worldwide, I'm Matt Miller in for Jonathan Farrow. Not deterred by initial jobless claims at 225,000, S&P futures up 0.75%, NASDAQ futures rallying more than 1%. The countdown to the open starts now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Good Thursday morning. It's the second day of the fish run at Madison Square Garden, and we begin with the big issue, recession signs piling up ahead of the new year.
Recession. The likelihood of a recession.
Will we have a recession? When will it be? How deep and long lasting might it be?
The leading economic indicators are negative.
Growth will undeniably slow.
The yield curve is pricing in recession. China is reopening.
The reopening being as quickly as it's happening probably complicates the Fed's, job.
Directly impacted by China reopening.
Putting a little bit of a bid under oil prices, putting a little bit of a bid under, inflation globally, through aggregate demand.
Let's assume we do have a recession next year. It's an open question.
Most likely a recession in 2023.
The economy is flirting with a recession.
But it's not here yet.
Joining us now to talk about this, CAS Investments' Matt Lindholm and Will McDonough of Element Funds. It does look like we continue to see more and more signs of a recession. On the other hand, the labor market is holding up strong. Will, let me start with you. What do you make of the jobless claims numbers? It just doesn't seem like the Fed's getting any traction.
Well, I think it's because people refuse to take their medicine. You know, we keep kicking the can with every single Fed meeting. And what you're seeing now with some of the news at the new year, I saw before Goldman Sachs making cuts, people are starting to realize this is imminent, this is real, and we need to take our medicine and we need to deal with this as opposed to just wait. I think we also saw that because the election cycle has just turned off, way more people are going to be comfortable doing that and admitting the reality.
Matt, what do you think? I mean, China is another big story. Yesterday, Italy tested Chinese travelers on 2 planes and found more than half had COVID. So you've got kind of the reopening on the one hand. That's, I guess, good for global growth, but also maybe inflationary. On the other hand, a huge surge in COVID cases that could push us back. How do you weigh it?
Well, it's always fascinating to watch how the market takes good news and bad news during rate hiking cycles. Certainly good news that China's reopening, we think, in terms of boosting global economic activity. But if that's bad for inflation and rates, then the market potentially reacts negatively. So, you know, we're focused on what to look for in 2023. We still continue to believe that the Fed's going to go through several more hikes, which is going to put pressure on corporate earnings, put pressure on balance sheets. And so we think moving up in the capital structure is a really nice way to insulate yourself in 2023.
Yeah, it's a good point. You know, right now we're at 450, Will, and I don't know if it's just me, but I feel like they have to do 50 again in February, and that's not the end of it. So is the market underpricing the terminal rate?
Yeah, I think you're definitely going to see them try to push some more in. Now is not the time. It doesn't make sense, like I said, in the political calendar. It doesn't make sense in the earnings calendar to not push in more pain here, right, coming out of the new year. But I think you're going to start to see those earnings reports really bring more trouble into the market. And you're going to see that the COVID pull forward really occurred where, you know, people that were buying cars, they all bought them in the last 18 months. People that were buying computers, they all bought them in the last 18 months. And so that demand got sucked out of the market. And these coming quarters are going to be really, really thin. And that's going to add tremendous pressure on our ability to get this thing under control.
And earnings. Matt, what do you expect for earnings? I'd love to get both of your takes because this seems to be a huge question. We're going to see Q4 kick off in a couple weeks, but you know, 2023 consensus is right about the same as 2022, and we haven't even hit that.
Look, we think in 2023 earnings have to disappoint. There are 3 things really that are going to drive things lower in our view. Number 1 is super obvious. That's inflation. That's putting pressure on cost of goods sold, driving it higher. Supply shortages are doing the same. Number 2, we have rising labor costs. That's putting pressure on one of the largest corporate items. That's SG&A. And number 3, naturally, higher interest expense from higher interest rates for floating rate borrowers. So we think margins have to come down. That's going to drive earnings lower. That's going to put pressure on balance sheets. So we think earnings are going to get revised lower throughout the next 12 to 18 months as investors sort of digest what has to happen in our view in most of these businesses. So it's a good time in our view to focus on recurring revenue businesses. And as I said before, looking to reduce leverage or move up in the capital structure.
Will, what's your take on earnings?
Yeah, I agree with that. You know, there's definitely be a consolidation, a flight to quality. You know, there are strong companies that have been hoarding cash. And so in an environment where the markets are down 20 and 30%, an environment where the dollar is less and less valuable globally, you're going to see the winners win, and you're going to see emerging markets, and you're going to see, you know, small and mid-cap companies have a really, really hard time. We also just came out of a period where companies rushed into the public markets, probably prematurely. And you're seeing a lot of that kind of truth serum come out now when people do publish earnings and people are recognizing that some of these are more venture than they are public.
All right, I want to get now the latest on that rapid reopening that we're seeing in China, triggering concerns really around the globe over a massive surge in infections. The U.S. and Italy join a growing list of nations now requiring COVID tests for travelers coming in from China. This as futures rise here in the U.S. off the back of the latest jobless claims numbers, which I don't 100% understand because it looks like the Fed's getting no traction. That would mean they have to go harder, and that would be bad news for the market. For more, let's bring in Bloomberg's Justina Lee. She joins us right now out of London, and Abigail Doolittle here in New York. Abby, let's start with you. The jobless claims numbers came in bang in line as expected. Doesn't that mean the Fed's going to have to go harder? And isn't that bad news for stocks?
Well, it's interesting, Matt, because this is a little bit of bad news as good news as for stocks, because relative to this number, you're right, it came in right on survey, 225,000 initial jobless claims were announced for the week ending Christmas Eve, but that's up 9,000 from the week before, and continuing claims, they rose by 41,000 to 1.71 million. That suggests that it's harder for those who are unemployed to find a new job. So that suggests that maybe shows you how thin these markets are. They're taking this little bit of bad news as the idea of good news that maybe the Fed's not going to raise. At least that's my interpretation from yields coming in and the future spiking higher. But to your point, yeah, it doesn't really make that much sense, because this suggests that the Fed is not really gaining all that much traction, that the labor market is still healthy. But again, this is a holiday week, thin volume, traders taking advantage of it, a couple down days. So right now we do have the S&P 500 mini futures up about 0.7%. The tech-heavy NASDAQ up even more, up 1%, because yields are down. That makes valuation a little bit more attractive.
Yeah, and of course, as you mentioned, very thin trading. Things can change on a dime in this market. We've seen it over the last couple of sessions. Justina Lee, let's bring you in and talk us through. It's also kind of on the one hand and on the other hand story with China, right? Because the reopening should be good news for global growth, but the spike in COVID is a real concern globally as well.
Right, exactly. I mean, after all this long time of global investors waiting for China to reopen, I think they're finally seeing that it's actually not entirely good news, at least not yet, because if we look at mobility data, I mean, that's actually plunged in a lot of the big cities, even more than during the lockdowns. And that's because people are hearing from their friends and family about infections climbing. They're getting worried about going out themselves. And so, and we can see this in Chinese stocks as well. I mean, they've kind of come down a little bit lately because of concern that spreading infections are now hampering economic growth.
All right, Justina Lee and Abigail Doolittle, thanks very much for walking us through those two big threads of the day. Matt Lindholm and Will McDonough still with us. I guess there is a lot of doom and gloom out there. On the other hand, you could be optimistic and hope that the Fed is going to end up cutting if things get too bad. But what's the possibility of something in between happening? Matt, what's your prediction for the recession that everyone expects us to have next year? Will it be short and shallow, or will it be long and protracted?
It's going to be a little bit of both. I think it's going to be more long and shallow, personally. We think that the Fed's going to have quite a difficult time landing this plane. We think that inflation, most of us investors have not been around in an inflation cycle such as the one that came from the late 70s and early 80s. So most of us have not lived this playbook before. We've got to sort of figure it out as we go and look at history and take what we can from that. So I think the Fed is going to have a bigger challenge than most investors are pricing in at this point. We don't want to be doom and gloom. We think equities are going to be challenged as corporate balance sheets, as I said earlier, are challenged. But I think the place to be is credit. We think, if you've seen anywhere from 400 to 600 basis points uplift in yields this year, you've got places you can find really attractive risk-adjusted returns, like AAA CLO debt is yielding over 6. Right now was yielding below 2 a year ago today. You have what we think is going to be really attractive dislocation opportunities in distressed debt, of which there's already $650 billion of globally, which is up 300% year over year. So I think it's a matter of which corners of markets you tend to focus on. And if you're looking at the right places, we think 2023 has plenty of attractive returns to offer.
It's a good point, Matt. And I guess you want to be in those A or B tranches, right? Because distressed debt is huge. Leveraged loans is even bigger, more than double what they were in, I think, 2007 or 2008, going into the great financial crisis. Will, what do you think about credit? A lot of people are talking about it, and obviously there are two sides to the trade.
With all thanks to Bloomberg, we all live in an environment today where we have this data to the millisecond. And having worked in debt and credit at Avenue Capital and having some exposure to those markets markets trade at a far greater lag to reality than the equity markets, right? So if you're trading FX, if you're trading equities, It's millisecond to millisecond, and people are day trading that stuff. These debt markets are way more thinly traded. You know, Joe Q investor on his couch cannot access those per se. And so there's going to be a bit more of a lag there. And I think that carries through to a lot of these themes where people are wondering, well, the Fed just did this the other day. I don't get why jobs claims have changed. Well, there's a lag to the real world, you know, that's not 140 characters. And it takes time for this stuff to push through. It takes time for these companies to, you know, like I say, take their medicine. And so we're going to see this thing over a lot longer period than I think people wish.
Yeah, long and varied lags, of course. Milton Friedman famously making that call, and then we don't talk about it for 20 years because we didn't raise rates in that time, or not at least this substantially. 450 basis points in 1 year. The idea is to tighten financial conditions, and in some ways they're getting tighter. We've seen banks take a lot more, set aside a lot more in terms of reserves. I think 75% in the last quarter, year over year. We talked about the distressed debt pile, the leveraged loans. Is the tightening gonna hurt at some point, Matt? I mean, are we gonna see a credit crisis?
We're going to see a credit crisis. Certainly, it depends on how much worse things get economically. But I think you are certainly seeing a major pullback in credit that's evidenced across lots of different metrics. You see banks very, very intentionally pulling back and starting to increase loan loss provisions. So, look, I mean, I think it's an environment where those who are lending are going to do so with much more scrutiny than they've done over the last several years, where money's been really, really easy. In the private loan market, you've seen covenants start to really, really pick up, and everybody sort of paid a lot of attention over the last 4 or 5 years that covenants were dropping, and everything was about price and being really competitive and just trying to get money out the door. And you know, we've gone full circle from that point to where we are today, which is things are really, really tight. Covenants are going to be strong and getting stronger, and the rate's going to be much more expensive. So it's going to be a lot more difficult on the equity side to both find the capital and to be able to afford the capital itself.
It's a great point on the covenants. These are the kind of things we start to pay attention to when the going gets tough. Matt Lindholm of CAS and Will McDonough of Element, you guys are going to stick with us. Coming up, Goldman Sachs kicking off the new year with some fresh job cuts.
You have to adjust to the environment, and so you make changes around the margin.
That conversation still ahead. This is Bloomberg.
More activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
You have to adjust to the environment, and so you make changes around the margin. It shouldn't be surprising to people watching the performance of the business this year that 2021 was an exceptional year. It was a record year for the firm. It was the highest revenue year ever for the firm. 2022 is a different year, and so naturally, compensation will be lower.
That was Goldman Sachs CEO David Solomon earlier this month. The bank now preparing a fresh round of job cuts for the new year, with as many as 4,000 jobs, or 8% of the entire workforce, on the line, according to people familiar who declined to be identified. Solomon blaming a slower economy and tighter monetary conditions in his year-end message, telling staff, quote, "The focus is on preparing the firm to weather these headwinds. We need to proceed with caution and manage our resources wisely." For more, Bloomberg's Kriti Gupta joins us now. Kriti?
Yeah, Matt, let's put this into a lot of context here, because, of course, Goldman Sachs, like every other Wall Street firm, and I'd argue large corporate firm in America, has been investing a lot in their talent. So the 4,000 jobs that you just mentioned would represent, in theory, about 8% of their workforce. But remember, going back to the end of 2018, their workforce has ballooned 34%, almost 49,000 people at the end of last quarter. So this is really kind of a pullback from the massive growth you've seen over the last 3 to 4 years. And also put this into context in terms of what they're actually spending their money on. They've really been expanding and investing in their consumer banking unit, Marcus. They've been talking about, like I said, hiring talent, but also updating their technology. Matt, that all takes a toll. Even though they are looking to make their second best record year, it is still something that they have to manage, and are doing so, by the way, through these potential job cuts. We still don't know how many or when we'll hear from them, but it looks like they're probably potentially more severe than some of their rivals.
All right, we'll continue to report, obviously, on every move they make. Kriti Gupta, they're talking to us about Goldman Sachs. Matt Lindholm and Will McDonough are back with us. The labor market is so fascinating because we've got all of these reports of job cuts just starting in banks, but for the whole year, we've been seeing them come out of the tech and crypto industries. When do we start to see unemployment start to climb? Will McDonough from Element Funds, what's your view on all these headlines with no real movement to the underlying number?
Well, 4,000 Goldman Sachs employees losing jobs is not going to make a lot of people cry, and those aren't people that are going to be waiting in soup kitchen lines. I think we need to focus the concern on losing manufacturing jobs in the United States and in, the central states of our country here really feeling this pain. All too often, I feel like the headlines focus on firms like Goldman Sachs. 4,000 people, that's a drop in the bucket. That's not real American pain, and that's not what we're really needing to, drive attention to and solve for. Firms like Goldman, I happen to know, having worked there, they do a good job at taking their medicine. And also, when markets are in retreat, they use that as an opportunity to trim fat, for lack of a better term, get lean and mean, and drive revenue to the bottom line. That's what smart companies need to do, is take that pain. The Fed is not doing that. The government is not doing that. Smart corporations are doing that. And so when you see the biggest companies in the world, of which Goldman is not one, might I say, but when you see the biggest companies in the world start to really admit the pain here and start to cut average American jobs, that's when you feel real pain push through, because then those people don't have discretionary spending. Then those people are really way more conscious about inflationary pressures on their groceries and on their gas bills. And, that's when Americans are really going to feel what we have upon us.
Right. Well, it's a good point. Obviously, we're focused on, so far, job cuts at companies on the East or West Coast, right? It's only about New York and California thus far. And we do see, if you look at bank balances, consumers still have money built up, even as savings rates drop. And this is a point we've been making over the past couple of days. Savings rates have plummeted, but the stock of cash in bank accounts is still near an all-time high. Matt, what do you make of the U.S. consumer?
What's fascinating about that is you still have a pretty strong consumer, as you say. You still have a pretty strong job market, at least in terms of what the data tells us. So that's going to give the Fed continued confidence to raise rates further, which potentially means that markets are going to be even more challenged in 2023. As you said, we come off a historically strong period in 2020 and 2021 following the outset of the pandemic. And so since that time, what we've really seen is that the consumer spent obviously a fortune, a lot of which was given to them as a result of being taken out of their jobs in 2020 and 2021. And they spent a lot of that money. And so savings rates are starting to drop and come down. Balances in savings accounts are down. And so we think 2023 is going to potentially be a lot different. And as companies sort of come to reality, as Goldman Sachs appears to have, we think that the jobs numbers are going to get a little bit worse through particularly the second half of next year as well. And that's when we start to see things potentially turn around and bottom out.
What do you like in terms of stocks right now, Matt? In terms of sectors, where are you investing?
Two places we're really focused on, as I said, we're looking at non-correlated assets in places where we believe we can find consistent recurring revenue with very low leverage. So if we're going to own equities right now, and these are a little bit out of the day-to-day, if you will, but we love owning private asset managers who have long-term locked-in contractual fees. They have a 12-year map of what their minimum revenue picture looks like. So we love that, along with low leverage on the balance sheet. The other place we really like right now is professional sports, which we really think is tailor-made for this investment environment. Lots of inflation protection, lots of predictability. Professional sports franchises have 60 to 80% of their revenue is known on January 1st, which is a really, really nice position to be in. Again, very, very low leverage, and a lot of secular tailwinds, we think, at their backs in terms of the rise of sports betting, in terms of cord cutting that's driving advertising dollars more to sports, and non-correlation. If you look at the tracking stocks that are out there, the Braves tracking stock is up 15% year to date. Man U is up year to date. Madison Square Garden is up year to date, all in an environment where the S&P is down 20 and bonds have been killed. So we think non-correlation in those two areas is really, really attractive and will remain that way moving forward.
Matt Lindholm joining us from CAS, Will McDonough from Element Funds. Thanks very much for your time. Coming up, the morning calls, and then later on, we're going to talk about a year of massive divides, breaking down the haves and the have-nots. That conversation happening around the opening bell with Carly Gartner of DeCarly Trading. This is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
This is the countdown to the open. I'm Matt Miller in for Jonathan Farrow. Let's take a look first off at what's going on in the markets just ahead of the opening bell. S&P futures still up 0.75%. The last few days we've seen gains in the morning and then moving down into the red by the time of the open. Not so today. Obviously still very thin volume in this holiday shortened week. The NASDAQ futures up even more, so a gain of more than 1% in terms of what we see in the tech stocks. It's time now for our morning calls, a look at some of the analyst action this morning. First up is Piper Sandler initiating coverage on Skechers. the shoemaker, with a neutral rating, expecting consumers to face a challenging environment next year. Next up, CFRA upgrading Netflix to a buy from a sell, so a big move there. The analysts moving from bearish to bullish, seeing positive catalysts ahead for the streaming service. And finally, the big call in cars. Morgan Stanley giving shares of Tesla a much-needed boost, cutting their price target down to $250, but pointing to new opportunities after recent declines. Of course, we've seen Tesla off almost 70% year to date, losing more than $700 billion in market cap this year. Coming up, Baird analyst Ben Callow on why Tesla is one of his best ideas for 2023 as well. Plus, energy shines as big tech tumbles. DeCarly Trading's Carly Garner breaks down a year of massive division.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
They've raised their inflation forecast.
Firm and immediate action.
He wants to destroy my country.
Elon Musk to buy Twitter.
Overturned Roe versus Wade.
Boris Johnson will call it
Donald
quits.
Trump's plan to overturn the
Unprecedented search warrant at the home of our former president.
Queen Elizabeth has died.
Xi Jinping got his third consecutive term.
Pound falls to an all-time low.
The shortest ever serving prime minister.
Presidents Biden and Xi shake hands.
FTX filed for bankruptcy.
The red wave that never was.
Protesting his zero COVID policy.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is the countdown to the open. I'm Matt Miller, in for my friend Jonathan Farrow as he luxuriates on a beach somewhere. We are moments away from the start of trading on Wall Street after really, I think, the final piece of important economic data of the year. Those jobless claims came in bang in line with expectations. There's the opening bell on the New York Stock Exchange. S&P futures were up 0.75% heading into this, so it looks like we're going to open up in the green. NASDAQ futures, an even bigger boost, more than 1% this morning as tech stocks lead the charge. Take a look at the euro dollar right now, still at 106. Actually incredibly boring. We should put cable in there, especially since this is John's show. The pound has been incredible to watch, down below parity after the mini budget in just a couple months ago, I think September 27th or something, and then up to 125. The U.S. 10-year yield right now at 386.18, so it climbed substantially, coming down a little today. And crude, I don't get it. 77.51, it falls even as China reopens. I guess it's the COVID concerns that are driving that down. Now, one man to watch at the open this morning is Elon Musk. Tesla getting a much-needed boost from Morgan Stanley's Adam Jonas. He sees, Jonas that is, 2023 as a reset year for EVs and for Tesla. Meanwhile, Twitter is bouncing back from its first major outage since Musk took over, restoring services after disruptions from New York to Tokyo. I didn't notice, but Ed Ludlow likely did. He joins us right now out of London. So Ed, tell us what's up for Twitter and Tesla.
Well, let's start with Tesla. We're up around 6% at the open, biggest jump, or on track for its biggest jump in around a month. But of course, it's still on track for its worst month, its worst quarter, and its worst year ever. We've just seen astonishing declines in this stock of late. Adam Jonas at Morgan Stanley is talking about an inversion of the pattern of 2022, which is where he sees 2023 being the year that supply outweighs demand. But he believes that Tesla is well positioned not just to survive that change or inversion in market dynamics, but also to extend its lead over legacy and startup competitors. He basically looks at Tesla's cost of production, the volumes that it can do, and the levers that it can pull in terms of price cuts, and says, yes, that puts Tesla in a good spot. The street has remained quite bullish, at least on the sell side over Tesla, right? There's a huge number of buys outweighing the number of sell ratings on the stock, although, there is evidence that what we're seeing now is a lot of dip buyers coming in and supporting this stock. We're, of course, on track for a two-day gain that will not do anything really to offset the declines of recent weeks, months, and the quarter. There have been problems with Twitter, as you note, Matt. There were outages. I noticed them, reports on down detector coming from, as you said, Japan, the west coast of the United States. Those have been resolved, and it's actually interesting to see Musk himself, once things got back under control on the platform, tweet that they're actually doing some work or major upgrades to the back-end servers, which is interesting that he kind of continues to be the voice of what's happening at Twitter day to day.
You wonder how society would change if those outages were permanent. Ed Ludlow, thanks very much, reporting to us from London. Shares now of Southwest and their passengers alike getting some relief as cancellations ease, disruptions dwindling down to a few dozen for Friday compared to thousands over the past few days, at least that we know of so far, right? It's not Friday yet, Kriti Gupta, so it could get worse.
It could get worse, but there's only 39 canceled flights right now for Friday. Compare that to today, where you have 2,356 canceled flights from Southwest. That's about 58% of their schedule. Compare that to Monday, where over 80% of their schedule was canceled. So you do actually see a lot of the pain earlier this week, but certainly coming back down. And the bright spot is that on Saturday, there are no delays or cancellations as of now. That could absolutely change. But at the heart of it is not a weather issue. And even Transportation Secretary Pete Buttigieg commented on that. He says, look, we're past the point where they could say that this is a weather-driven issue. And of course, Matt, you and Kaylee Lyons interviewed Helene Becker yesterday about this very issue. Southwest was really lagging in terms of investing in their technology, and it is now kind of catching up to them, despite having access to a lot of the funds that they were able to get during the pandemic, and simply this idea of a lot of the federal aid that the airlines were able to get. But alongside airlines, you are also seeing a major move in a lot of the oil stocks as well, despite oil actually being down. So I think this divergence here that you're starting to see in the cyclical natures of not just airline stocks because of the Southwest issue, but also these oil stocks is really significant. Going into 2023, how do you play a recession? Do you buy into this idea that expansion is coming down the road and therefore buy into the oil stocks that have actually performed so well? Or is there going to be some sort of snapback now that the commodity is lagging?
All right. Excellent questions posed, Kriti, and I'm sure investors are pondering them as we speak. Kriti Gupta there with a look at oil and travel. Now, a clearer picture is developing for winners and losers of 2022, which is great because the year is almost over. Breaking it down for us here is Abigail Doolittle. Abby?
And what a year it's been, Matt. It's really incredible. The spectacular moves that we've seen in 2022. And if you recall, it started off on a bright note. In fact, there was a Santa rally last year, but it did not successfully predict this year because we have haves and have-nots. And of course, for those have-nots, I'm thinking about stocks. That S&P 500, essentially in a bear market right now, heading to its worst year since 2008. That's true, too, for the NASDAQ 100, deeply in a bear market, down 34% this year, also the worst year since 2008. But it's not just stocks, and it's interesting because we've been talking about how the 60-40 portfolio has had its worst year since 2008. Well, that has to do with the fact that Treasuries notes price on bonds, Treasury, U.S. Treasuries, down 13%, but credit, too, high yield, down 16%, HYG having its worst year ever going back to 2008. So this is a picture of the pain, but there's so much more. However, it's not all bad, especially for stocks. It's interesting. We have had a couple sectors outperform. Energy is up 57%, not so surprisingly. Defense and aerospace also up 14%, perhaps having to do with the Russia-Ukraine war. That's also an influence on the commodity complex, up 13%, despite the fact that you also have that dollar up for a second year, up about 7%, the best year since 2015. In fact, the dollar could be one of the biggest drivers going ahead right now, breaking down to some degree, technically on an important level of support. Whether it holds or not will be a critical tell. Let's now bring in Carly Garner of DeCarly Trading. Great to have you with us, as always, Carly. And you're so expert on so many different areas, whether it's futures, stocks, commodities, options. You're a broker, you're an analyst, you're a businesswoman. You know, so for this year, thinking back, that started in one way and then has ending in quite a different way. What stands out to you after, again, so many sleepless nights as an actual trader? What stands out to you as the biggest surprise of 2022?
Yeah, you're right. It's definitely been a wild year, one that we're going to remember for a long time. The thing that sticks out to me is you mentioned earlier, commodity indices are up on the year, but the commodities that performed well are not the commodities that we talked about all year. We spent all year talking about commodities that were affected by Ukraine and Russia, but as it turns out, those are the commodities that kind of fell victim to speculation because we had big cash inflows and cash outflows that it probably is holding back some of the performance there. On the other hand, markets that none of us even mentioned, like orange juice, soybean meal, rough rice, those are the ones that are on the top of the heat map. So it's been really an interesting year and a lot of lessons regarding boom and bust in commodities. You want to be really careful chasing commodities higher because those kinds of euphoric rallies, they're exciting, but it's a lot like the meme stocks, right? We talked about meme stocks and crypto getting speculation dollars and pushing prices to unsustainable levels. Well, that happened in commodities as well.
Yeah. Well, I forgot to mention those meme stocks in crypto because that was definitely a big part of the bust. But a big driver going forward, probably the dollar. You've had great calls on bonds and the dollar. Right now, that dollar index, again, up about 7% on the year, a second up year in a row, up more than 10% over 2 years. Technically, it looks a little bit vulnerable to me. What do you expect, and what does that mean, more broadly speaking, not just for commodities, but stocks, too?
I agree. The U.S. dollar looks vulnerable to me to additional selling. It's still relatively high if you look at a historical basis. Most of the markets that were impacted by the Russian-Ukraine drama and then the inflation boom and all these other things that happened, most of those markets have fallen back into the price range that existed before March of 2022 when the fireworks went off. And I expect the dollar to do that as well. So that should push the dollar index down here, at least in the first half of the year. And a weaker dollar is going to help commodities. So a lot of these commodities that have been experiencing liquidation in the last couple of months might find some support here sooner rather than later.
Well, that's what I wanted to ask you. You were talking about the impact of the Russia-Ukraine war on commodities being a little bit surprising. What trading opportunities do you see for 2023?
So if you look at the main commodities that were involved in the Russia-Ukraine war, it's crude oil, wheat, and natural gas. And each of those commodities, if you look at a weekly chart, we basically have a really nice contained trading channel that's been going up slowly over the years. If it weren't for the Russia-Ukraine drama, which allowed those commodities to trade up above their natural habitat, we probably would have stayed in those ranges. So, for example, in wheat, we're talking from $8 to $10. In crude oil, we're talking from $70 to $95. In natural gas, probably somewhere around $4.50 to $7. So I expect markets to stay within those ranges unless there's another black swan event. But I think we're pushing our luck to get 3 black swan events in 3 or 4 years. So hopefully it's a quiet year.
Well, we had reports out of Italy that they randomly tested 2 flights from China and found more than half of the passengers were COVID positive. How does that strike you, Carly?
Obviously from the demand side of the equation, there's a couple things that I have in my mind. even if China fully opens, the China that's reopening is not the same China that closed down. So we can't expect the same kind of numbers coming out of China, in my opinion. The Fed is still raising rates, although they're hopefully getting towards the end of the cycle. And the reality is traveling is not that fun or convenient anymore. So I think that from the demand side of the equation, there might be a lot of analysts are probably a little optimistic, in my opinion. So I'm not bearish crude oil. I think that the path of least resistance is higher into the mid to low 90s. But I also think that $100 oil is probably not in the cards, and at least not on a sustainable basis.
Are you concerned about a new spike in COVID cases globally? I mean, we see eye-popping numbers out of China, and the fear, although maybe it's sensationalist, is that they bring that over here, and we see a reversion to the pandemic of 2020, 2021.
Well, I mean, time will tell, and I'm not a scientist, so I don't know how that will impact. Most developed societies are relatively vaccinated or have natural immunity, so I don't expect that to be an issue going forward. But then again, I didn't expect anything we've seen in the last 2 years, so time will tell.
In terms of the Fed, you hope they're going to slow down. It seems to me that market pricing doesn't really match Jerome Powell's commitment to defeating inflation. I mean, isn't he going to raise 50 basis points in February and then keep going?
Well, the market's expecting a continuation, but I think all the market really needs to see is a slowdown. Markets are forward pricing, and so they're not looking for what's happening in the next month or two. They're looking out a year or so. So even if they continue on their quest, I think that from a commodity standpoint, a lot of that's already baked into the cake. So it may not necessarily push prices dramatically lower, but it's already in the cards.
It's already priced in. Carly, thanks so much for joining us. Really appreciate your expertise this morning. Carly Garner there of DeCarly Trading, talking with me and Abigail Doolittle. Now coming up, Tesla's worst year ever.
It is a concern for Tesla. Are they a car company or are they a technology company? And I would say the valuation has to reflect whatever it is that you believe.
We're going to talk with Baird's Ben Callow. He says Tesla is one of his best ideas for 2023. That conversation coming up next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So most actors are thrilled if they have one part like Rocky in their whole career. Yeah. You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No. Rambo was a novel by David Morrell. And I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone. And it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time you go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because similar to James Dean in East of Eden. He wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It is a concern for Tesla. Are they a car company or are they a technology company? And I would say the valuation has to reflect whatever it is that you believe. I personally think that it will come back, that whatever he's doing politically through Twitter is tarnishing his image and causing a lot of people not to want to buy his cars.
Tesla preparing to close out its worst year ever in terms of the stock, right? Down nearly 70% year to date. Reuters reporting that the CEO of Tesla, Elon Musk, told staff not to be bothered by, quote, stock market craziness. All this as Twitter recovers from worldwide disruptions. Of course, two different companies, one CEO. Bloomberg's Ed Ludlow is back with us for more. So I do want to continue to give people the caveat, Ed, that if you're a long-term investor in Tesla, it's not so bad. Over the last 5 years, the stock has still, with this drop, quintupled.
It has, but, you know, the fact of the matter is we are still on track for our worst month on record, our worst quarter on record, and our worst year on record. And $6.7 trillion of market cap have been shed this year to date, or so far. There's just 2 days left in it anyway. Tesla accounts for $700 billion of that. It was interesting what your previous guest said about, is Tesla a car company or is it a technology company? In cutting his price target from $330 to $250, Morgan Stanley's Adam Jonas, who maintained an overweight rating, did say that at least $43 in his cut comes directly relating to the core auto business. And what's really interesting is that he talks about 2023 being the year of inversion, where supply outweighs demand instead of demand outweighing the company's ability to supply. What's really weird is what's happening in the last two sessions, right, Matt? I mean, you and I feel like you and I have been talking about this stock every hour for the last 14 days because we have, you know, we're up over the two-day basis. There is evidence of dip buying being part of the factor here. This was also, you know, the most oversold the stock's ever been. And, you know, it's coming off that level now from an RSI perspective or relative strength index perspective, but it's still all the way down there.
I like
exactly. That's a beautiful chart. I guess the question is, we don't have a better sense, really, of how much of the buying comes from Musk's comments overnight to employees that they should ignore the markets and focus on the long term. Are you focused on the long term? That's the question.
I'm focused on the Fish Show tomorrow night at Madison Square Garden. I'm already getting pumped up. Ed Ludlow, thanks very much coming to us out of London. Let's get over to Ben Callow, Baird analyst, cutting his Tesla price target, but also adding the stock to his best ideas list, writing, quote, Tesla is best positioned in the auto market as EVs continue to take share of the total market. Additionally, its other opportunities, such as Tesla Energy, will continue growing in 2023. Ben Callow, I'm pleased to say, joins us now. Ben, you know, Adam Jonas had a similar thought on Tesla, and obviously it's fallen so far that it feels like there's nowhere else to go but up. Doesn't Tesla, though, have a lot of competition coming into the market next year?
So thanks for having me, and Happy New Year, and I hope you have fun at FIS. They do, but we've heard that for 5 years, and they would continue to hear it, 5 more years. I think that, what we've seen over the past, 12, 13 years I've covered Tesla is they continue to develop, continue to increase their technology, continue to outpace competitors, or continue to lag. And so, I'm not worried about competition as much as I'm just worried about the general economic environment. Do people have the wallets to pay for $60,000 cars? And I think that's what the market's worried about too. Is Elon, spread too thin? I don't know what he does, but I think that he is proving that he can hire the best talent out there, retain the best talent out there. I just saw a report that they had 2 million job applicants in 2021. And the number one place for engineers to go, they want to go work in surveys is SpaceX. Number 2 is Tesla. And so that's what's the biggest competitive advantage that Tesla has, is the people that work for them versus going to name the other automaker.
Well, and he was out yesterday with a letter apparently warning them not to get too caught up in the stock market craziness. The stock has dropped to 100, and I guess the low was $108.24. Looking at my Bloomberg terminal here, is that the bottom, you think, for Tesla, Ben? Have we seen that? Was that 7-day route the worst it's going to get for Tesla shares?
I think so. I mean, that's why we came out yesterday, and it's good that my friend Adam Jones came out today, reiterating outperform. But I think that was the low. We had a lot of tax loss harvesting that was going on, I think, in the retail market. And so I think, we get deliveries next week. We're positive on this quarter and going into the future. There's been a lot of noise out there. It's just ramped up. It reminds me of 2015 or 16 in Tesla here.
Well, I think tax loss harvesting has to be my phrase for 2022. Certainly for the end. Eddie Vanderwalt was on Bloomberg Radio this morning saying, one strategy that a lot of people are likely to follow, especially with Tesla, right, is you've taken such a hit this year. Even if you love the stock, or especially if you love it, you might as well sell it now and then buy it back in January. That way you get the tax benefit and you're still invested.
Not a bad idea for short-term traders. I think that I cover stable energy mobility at Baird. I think that you own this as a core holding in the energy and mobility transformation that's occurring right now. It's going to be helped by the Inflation Reduction Act next year. But short-term trading, not a bad idea, except you're going to have, I think, very good delivery numbers next week.
There are also rules. I think you have to wait 30 days before you buy back in. I, for one, am excited for the Cybertruck. I might be the only one who's excited about it. But is it coming out next year, Ben?
Yeah, so we have some deliveries in our model for next year. The reports are out, and we've seen robots being delivered, machinery being delivered down to Austin for the Cybertruck. I think this is another thing about tech stock. We should have expanding gross margins, even though they're decreasing price. And we have a new product out there with the Cybertruck and with the semi-truck that should be getting on the road. And then it'll get people tearing them down and talking about their technology. That'll be a catalyst for the stock too, I think.
Ben, thanks so much for joining us. Ben Callow there from Baird talking Tesla. Coming up, the market-moving events you need to be watching. That's next in our Trading Diary.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the U.S. are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
Quick trading diary, here's what to watch. U.S. crude oil inventories coming out at 11 a.m. Then inflation data from Spain and Russia tomorrow. Plus the bond market closes early for the New Year's Eve holiday. Markets in the U.S., U.K., and Europe close on New Year's Day next Monday. This was the countdown to the open. I'm Matt Miller. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
From New York City to our audience worldwide, good day, good in between the holidays trading day to you. We are cross-platform. We are simulcasting on radio and TV. I'm Caroline Hyde. Paul Sweeney in the house. Markets getting a leg higher. Most importantly, Paul, how was your steak last night?
Steak was fantastic. Went to Benjamin's in Midtown Manhattan. They took care of us, had a wonderful time. No faux meat last night.
What was the inflationary pressure like there?
Oh, the New York Strip, which usually in New York City, Midtown is about $48. Pre-pandemic, $60 last night.
60. Okay.
Yeah.
Inflationary pressure still hot. Job market. Today we get the actual crucial data there, and it looks like there's still resiliency. So even as the Fed fights this inflation that you're so tasting, it would seem, over at the steak restaurants, we're still seeing a market that sees the jobs looking strong, jobless claims coming in where expected. We've got quite a nice rally on our hands on the back of that data.
We do. We got the S&P up about 1.3%, a nice rally off of the first couple of days of this week, trading days, which were kind of weak, and then NASDAQ up about 1.9%. So we've got the VIX. I'll call that out for Tom Keene. We're now below 22 on the VIX here. So some good trading. You know, volumes are light, as you would expect, about 15% below recent averages, but a nice little green on the screen.
It's interesting, the VIX at 20 was where the capital markets co-head, global co-head of UBS wanted to see it to get those IPOs that are still sat there waiting on the bench for the rest of 2023. But interesting as we digest this jobless claims data, as we digest the resiliency, the strength of the jobs market, I know we're going to discuss throughout the hour jobs market affecting technology, but also the jobs market affecting bankers, right?
Exactly. And our good friends at Goldman Sachs out with some news over the past couple of weeks, culling the ranks, and we want to get a sense of kind of what's going on with our good friends at Goldman Sachs. We can do that with Sri Natarajan. He covers all things financials for Bloomberg News. He joins us here in our Bloomberg radio studio. So Sri, talk to us about what's going on with our good friends at Goldman.
Well, a couple of weeks back, you already saw press reports that Goldman Sachs was going to go deeper than any of its mainstream banking peers, with a pullback that could be up to 4,000 jobs getting cut, or about 8% of their workforce. Of course, until yesterday, Goldman itself hadn't confirmed any of that, but in his traditional year-end message, Goldman Sachs CEO David Solomon really didn't come in with that typical holiday cheer. He spent almost...
Is it usually full of holiday cheer in amongst the DJing?
Even if it's not a lot of the holiday cheer, it is a lot of the rallying the troops and encouraging them for the year ahead, congratulating on the year that just went by. But this one, about 2/3 of the message was dedicated to talking about the headcount reduction. And perhaps he's right in doing that. You might as well give them the harsh medicine up front, because he gave us a little bit of news yesterday when he said that the job cuts will be coming as soon as the first half of January. So that's just a matter of weeks. And if they do go ahead with job cuts that amount to, 3,000, 3,500, 4,000 jobs, you might as well want people on guard, even if it's the last week of December. And that's when the CEO went out and said it's a very uncertain 2023 that we're entering. There are a lot of pressures on the business. He's already talked about it in the past, including with Bloomberg Television, about the pressures that they have been facing on their own expense line. And with that increased investor focus on costs, Goldman Sachs wants to get out ahead of the narrative. It already knows it's unlikely to meet its return on equity targets, and it needs to show investors, it needs to show its shareholders that it recognizes that, and it's taking measures and steps to address that.
That it cares about margin, but also, is it because we, through COVID, got rather used to a lack of culling, a lack of this getting rid of the bottom rung that we'd all anticipated usually year in, year out over at the likes of Goldman?
Across the banks, many of the banks came out and made this pledge that they would not cut through the pandemic. Goldman Sachs, in fact, was one of the banks. Of course, they weren't completely true to that pledge. They did carry out some cuts, especially in late 2020, but by and large, it was nothing like what they typically tend to do. And their workforce in the last few years, I believe since the end of 2018 through the third quarter of 2022, has grown about 34% to more than 49,000 people. So there's clearly been a lot of growth. They've nibbled away at a number of acquisitions. So there has been an inflation in their ranks, perhaps more than the price of your steak last night.
Yep.
So they clearly see that there is room for making some cuts. There is room to become leaner. And that's what they're aiming for, because that's the message they want to send. Remember, next month they come out with earnings, and of course, sounds like with these job cuts announcements around the same time, a month after that, they will undertake another investor day. Goldman Sachs typically has never done that. It's never had investor days for its shareholders. It came They came out with a debut investor day in 2019. That was the first time ever that Goldman Sachs did it. And of course, they met a lot of those targets, but it's unclear how much of that was strategy realignment and how much of that was pure luck of COVID and the pandemic and the windfall that it unleashed on Wall Street. But 3 years later, the pressures are very different. Now we're going from a windfall era for the banks to something that will look like a more normalized environment, and where strategy is what will help differentiate one bank from another. And that's what Goldman Sachs is eyeing. And that's where they want to go in and give a proper message to give shareholders some reason for cheer, because this stock doesn't have the same kind of enthusiasm from investors as some of their main peers. And they want to address that, and they want to correct that.
Shri, thank you for taking us through it. The over-communication currently going on at Goldman and perhaps trying to tame any over-exuberant stake ordering as we head towards the new year. We thank you, Sridhar Natarajan, of course. And let's talk more broadly about these markets, the ones that Goldman Sachs have been trying to navigate over 2022 that, look, most of Wall Street got pretty blindsided on. We want to talk about all of this with Callie Cox, of course, who's going to be joining us, US investment analyst over at eToro. And Callie, as we sort of digest what was a brutal cross-asset year in 2022. Are you licking wounds at this moment? Are you thinking more optimistically about 2023? Where do you stand?
Well, hey, I'm a cup half full person, and I think it's hard to say that 2022, it's hard to be these days, but I think it's hard to say that 2022 wasn't painful because of that cross-asset sell-off, just the pain we saw across a bunch of different markets. But I think that could portend good things in 2022, knowing that investors are sufficiently anxious and they're properly hedged going into 2022. I mean, the whole talk of, or 2023, the whole talk of the economy this year was about whether a recession is coming. So I do take some comfort in the fact that a lot of us are braced for that, and weakness may not catch us off guard.
Caroline, I have a real problem with Callie Cox. She is a proud alum of the University of North Carolina at Chapel Hill, and as a Duke person, this is really troubling. I will try to power my way through it as a gentleman. Callie, a lot of folks are saying there's still earnings risk in this market, and this is still something the market has to deal with in 2023. How do you guys think about that?
Well, Paul, first of all, I respect Duke. It's a great, great school. We have a healthy rivalry.
Yes, we do.
Lots of respect. I think there is quite a bit of earnings risk there. We haven't seen earnings estimates come down too much. And I think that's partially because companies have been resilient and demand has been much healthier than expected. But we're still watching Fed rate hikes and a bunch of other risks matriculate throughout the market. And companies are, like we talked about at Goldman, companies are responding. They are, putting their guards up a little bit just to make sure that they are prepared if we do see more weakness. Again, that's a good thing. That could keep a floor under earnings, but I don't think the weakness is quite priced in yet, and that could lead to new market lows if we see some recessionary price or some recessionary cuts being priced in.
Go global for us, Callie, because perhaps more weakness to come in US stocks. What about global stocks more broadly? Have we seen enough of the pain trade there already in the likes of Europe and Asia, or no?
So globally, I think there are a lot of opportunities for U.S. investors if they're willing to think outside of their borders. Obviously, the global economy is in a more precarious position right now, with some bright spots, China reopening being the brighter one going into the new year. But the fact that the global economy is out of step with the U.S. economy could allow for some interesting diversification opportunities going into 2023. The fact also that, European markets and Asian markets have priced in a lot more pain does make them ripe for, more of a rebound, especially if we see ourselves come out of this weakness.
Hey, Callie, really since, the great financial crisis, what's really been driving this market in large part was technology stocks, and maybe more narrowly defined the FANG stocks and things like that. But what kind of role do you expect big tech to play in the next market move, to the extent that we get a little bit of a lift in maybe sometime in 2023?
Well, so tech is an interesting space right now. Obviously, there are a lot of different flavors of tech. The big tech companies look a lot different than the more speculative tech companies, and we've seen that in performance throughout this year. As we step forward to a Fed pause, most likely, potential rate cuts in the future because the Fed is insistent on getting inflation down, and there could be a policy change after that. I'm talking way far into the future. But as we step forward to that, as we prepare for, a potential bull market after this, it could be interesting to, maybe look at those more quality tech companies, big tech with strong balance sheets, to get some exposure to a market that's looking ahead. We don't necessarily think rate cuts are on the horizon, and tech in a higher interest rate environment there could be a lot of pain still there for a lot more, for the more speculative companies. But at the same time, you really have to be thinking ahead here, and big tech could be an interesting spot to do that.
And the NASDAQ currently up almost 2% as we speak, thanks to the likes of Apple, Microsoft, Tesla even getting in on the action again today with an 8-point net change on the benchmark. But talk to us, go cross-asset. As we see, in many ways, the correlations of this year has been when the bond market has sold off, yields risen, NASDAQ has sold off in sympathy. What do you make of the bond market for coming 2023? Are we like to see yields being capped out at these sorts of levels? Are we likely to start to see a little bit of buying at these sorts of numbers?
Well, we're in a weird environment, but I think we can all agree that inflation is slowing, and it's going to take a lot to, get it back to the peak that we saw this summer. And I think that's good news for bond investors, especially if we do see a recession in 2023, which definitely is not out of the question here. We could see bonds return to their traditional role of being that safe haven asset, especially around the world for global investors. And that goes back to the global economy being out of step with the U.S. economy. Lots of pain there, but also lots of opportunity. So we see opportunity in long bonds. Obviously, shorter bonds, shorter term bonds follow what the Fed is doing, and it doesn't look like the Fed's going to be hiking much more from here. So we could see a return to a more traditional asset correlation.
All right, Callie Cox, great stuff. Thank you very much for taking the time. I guess good luck to the UNC Tar Heels going forward this season. Callie Cox, U.S. investment analyst at eToro. We appreciate getting her thoughts on these markets as we look ahead to 2023. It's got to be better than last year, doesn't it? In 2022, we can only hope. Let's go to Lisa Mateo right now. She's got world and national news in New York City. Lisa, what do you have?
Good morning, Paul. Well, thousands of stranded flyers in the U.S. who are booked on Southwest Airlines may get some relief soon. So far, the carrier has canceled just over 36 flights for Friday. More than 2,300 have been canceled today, about 58% of Southwest's schedule. The airline is trying to recover from disruption caused by winter storms and outdated scheduling technology. Another sign of how the U.S. labor market is staying resilient despite the Fed's aggressive efforts to cool demand. Applications for unemployment benefits rose last week, but remained near historic lows. Initial jobless claims increased by 9,000 to 225,000. That was in line with median forecasts. And in Italy, authorities didn't find any new COVID variants among recent arrivals from China who tested positive for the virus. That's a relief for officials worried about fresh health threats. Both Italy and the U.S. have joined an increasing number of nations demanding COVID tests for travelers from China. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg. Caroline.
Lisa, thank you so much. Let's have a quick check-in on these markets. Globally speaking, we're seeing a day that is higher, not including Asia. I have to say Asia saw a downwind. The Hang Seng, the Nikkei closed on the red side. But at the moment, the Stoxx 600 over in Europe getting a bid. We see the FTSE only up about 0.2%, but outperformance coming from the CAC 40. The DAX is up 0.9%. Still, though, volumes are very thin. Paul, we're seeing the S&P 500 up 1.4%. Nice rally, almost 2% higher on the NASDAQ. And once again, Tesla actually managing to get a bid on the day.
Yeah, getting a little bit of dip buying, if nothing else. So that's good for the likes of Tesla. The fundamentals are there for a lot of investors, a lot of analysts, but that the Elon Musk risk has been something to really overcome this year.
Well said. We're going to dig into all of that. The outages at Twitter that we've just seen on the day. Tesla, of course, the worst stock, I think it's this year that it's ever had, but it's actually had its worst month as well. We're going to be discussing all of the Elon Musk effect in a moment. From New York and worldwide, this is Bloomberg.
innovation strikes. Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Welcome back. This is Bloomberg Markets Live. We are simulcasting across radio and TV. Caroline Hyde and Paul Sweeney. And Paul, it's interesting as we digest some of the data today. Big weakness in the US dollar on the back of jobless claims. Really amazing considering the resiliency of this jobs market. And we start the show talking about Goldman Sachs likely to see more job cuts to come, and the amount of job cuts we've already seen in technology more broadly.
Right, and you got to get a sense of how reflective that is of the general economy. And a lot of folks would argue, you know, Silicon Valley is not reflective of the general economy. Wall Street is not reflective of the general economy. And you kind of see that in the broad macro jobs data. But if you're in the camp calling for a recession in 2023, presumably you're still looking for weakness in the jobs market, and we're just not seeing it as of yet.
And I think perhaps some of that weakness doesn't evolve from the huge swaths of layoffs that we see at Meta and some of the big tech companies, because these people are so much wanted. The talent pool is still so tight. And in fact, as we see the resiliency, overall, some of these tech job layoffs, just basically, we see a lot of these companies get snapped up by rivals. But what's interesting is it's perhaps not just technology firms snapping up other technology talent. Financial companies are doing the same. Financial services firms getting in on the act. And I had a really interesting conversation a couple of weeks back with the hedge fund giant that is Millennium Management. Its global head of talent acquisition, John Tallarico, sat down and really talked about how they're looking to hire these sorts of talent from the technology space. Just take a listen.
We've put 294 technologists, I think the number is, to work this year, with 100 openings still listed, or 100 plus on our career site. In 25 years of me running technology talent acquisition programs, I've only seen a few of these disruptions, but I'm happy to say Millennium can be a welcome destination for those finding themselves on the job market.
So talk to us about at your shop and others, and I'm sure rivals might be doing something similar at the moment. What kind of candidates are you looking for? What type of roles are you filling?
Great question. First, it starts across all levels, whether you're beginning your career or whether you want to be in a senior global position. We're recruiting across all of those levels. We also recruit across all of those technical competencies that I personally think are so attractive. Not only software engineering and full stack engineering, but security engineering and cloud engineering, and these roles that involve unbelievable amounts of data within this industry that make things really, really exciting. And so over sort of a fairly typical technology stack, we seek those individuals that can solve problems, that have grit, that are scrappy across a wider range of opportunities.
Okay, so I can see if I was a technologist coming perhaps upended by the fact that I've just been let go by one of the big technology companies, I'm thinking, oh, I can get intellectual stimulation with Millennium. What about culture? Because many would say, perhaps, in an uninformed or naive way, but certainly I would go, oh, finance on one side, hardworking, long hours, perhaps in the office, technology, more softer culture. What are you having to decide and educate people about in terms of your culture?
Well, I'm really happy you said that, because in my opinion, what we offer in the aggregate is really powerful, and it's really special. It's not only that technology opportunity, it's not only the connection to our businesses, it's not only the impact you can provide, it's the respect for the individual and the collaboration on site, and the fact that respect and the way we go about working with each other is extremely positive. And I'd love the chance to sort of talk to those who may think that would be otherwise.
Okay, so let's just think about being in the office or not. If I'm used to a hybrid culture or indeed a completely fully remote one, how are you thinking about where the talent is that you can hire?
So first of all, from a location perspective, globally, we're building out Miami, Dublin, Tel Aviv, Bangalore, and Miami's going to be a big tech hub for us. We also have traditional opportunity in New York and London and Singapore, but we're also making sure that we are very, very focused on making this talent, knowing there's some flexibility in our model, right? We are enjoying returning to the office. That collaboration is really important to us. We can be flexible as well as global location flexibility.
when you say Miami, I immediately think of crypto. And does it matter which sector, which part of technology? Because basically, technology's horizontal, it's not vertical anymore. But does it matter what type of company these people are coming from?
In short, no. If the technology skills align, those cultural attributes, the sort of degree of problem solving, of course that's interesting to us, but whether it's tech sector, crypto, or existing sector, or any other talent that's interested in what we're doing, the domain is not a prerequisite.
I've had lots of conversations with people in finance, particularly those who are trying to hire talent, about the need for diversity, the need for pipeline.
Yeah.
I imagine technology fights that good fight too, and worried about its own pipeline, ensuring that they have diversity in the workplace. How are you thinking about that when you're starting to hire these technologists?
Yeah, it's a great question. It's extremely important to us. We've seen really great activity in terms of females in the technology space and going into universities at greater rates and coming out of those programs at greater rates. And cultural and racial diversity, incredibly important to us. It's all about diversity of thought, and we get that from all those different pockets. So heavy focus on all of that, whether it's through affinity networks, through paid-for programs, just through making sure we are out in those right pockets with folks that help us as third parties to identify where that talent may sit. It's really important to us, and it's going to make us better.
What are the ways in which you're having to be creative in the way you hire? Because, as I said, I'm pretty sure Millennium, you're out here talking about this, but I'm sure Brevin Howard, some other big asset managers, alternative asset managers are doing something similar. How do you set yourself apart? How are you looking for alternative types of people to come to you?
So at Millennium, in my opinion, and specific to my organization, I think we do a really good job of casting a really wide net. We need the best talent. So whether it's having strategic relationships with search firms, whether it's using LinkedIn, whether it's using our vast employee network, whether it's thinking about where these pools of talent may be that could be attractive to us and then advertising accordingly to those pools of talent, there's nothing that you could probably think of that we don't do. We want to get the very best talent, and so there's nothing in terms of a strategy we wouldn't try.
Well, there's still a tight talent pool somewhere, it would seem, certainly in tech.
It's interesting to see, because I think, Wall Street for the last decade at least, has had the risk of losing its talent to technology companies and not being able to attract the MBA talent coming out because they were going to tech companies. Now, maybe a little bit of reversal here in the short term.
The ebbs and the flows.
Yep, ebbs and the flows. All right, let's talk about one of those big tech/auto companies, talking about Tesla. Some improvement trading in the past couple of days here. Ed Ludlow joins us here. He's been following this saga, and I will call it a saga, in 2022. He's in our London office, I believe. And he's all over. He's in San Francisco, then he's in New York, and then he's in London. He's so global, but I think he's in London. The Queen Victoria Street station, by the way, folks, is just extraordinary for Bloomberg. Ed, so we seem to have a little bit of a bid for Tesla stock here. What do you make of it? Is it just kind of some folks looking for a bargain?
Yeah, it's interesting. I mean, we're up 8% right now, biggest jump since July. So this is a real rally, a real rebound. You had to point out that this is a stock that was deep into oversold territory, right? The most oversold it's ever been from a relative strength index or RSI perspective. But as you guys said, there does appear to be some support for the stock after that Morgan Stanley Adam Jonas note. And it was really interesting because he cuts the price target from $330 to $250 a share, but maintains this overweight rating. And he's basically saying 2023 is the year where supply will overtake demand. There will be an imbalance. There are concerns about demand. But he actually thinks of all the players, Tesla as the market incumbent and technology leader is best placed to weather that change in dynamic.
Talk us through that, though, because everyone's talking about competition. And why does Tesla still remain out in front? Will they not be snapped at the heels? Will market share not have peaked in the way that Cowen analysts have thought that it has been?
Yeah, I mean, I would say, Jonas, let's just say he's a Tesla bull, okay, just for the sake. And you're also leaving out any further erosion to the stock related to Elon Musk and Elon Musk's equity reputation and stuff. But he's basically pointing out that Tesla's already manufacturing at scale. It has the levers of being able to cut prices and use other incentives to pick that demand back up. Its cost of production is much more competitive. And he's basically saying we're looking at their global footprint. We don't think that their volumes will drop. We don't think that they'll miss our existing production forecasts. They might book less revenue. Why? Because they have to cut prices, and that brings the average transaction price down. They have to use incentives. But actually, they're so competitive and their margins are so far ahead of the rest. Morgan Stanley are actually arguing that that could be the year where Tesla jumps even further ahead of the competition because they'll just weather that storm better.
Ed Ludlow, stay well, our global friend. Great analysis of Tesla. Now, Elon Musk is a guy who likes the number 420. We all know why. Let's talk a little bit more about marijuana sales. New York State kicking off legal recreational marijuana sales today. We'll discuss that next. This is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
They've raised their inflation forecast.
Firm and immediate action.
He wants to destroy my country.
Elon Musk to buy Twitter.
Overturned Roe versus Wade.
Boris Johnson will call it
Donald
quits.
Trump's plan to overturn the
Unprecedented
election.
search warrant at the home of our former
Queen
president.
Elizabeth has died.
Xi Jinping got his third consecutive term.
Pound falls to an all-time low.
The shortest ever serving prime minister.
President Biden and Xi shake hands.
FTX filed for bankruptcy.
The red wave that never was.
Protesting his zero COVID policy.
Welcome back to our global simulcast radio, TV, joint forces, Bloomberg Markets Live. It is Caroline Hyde and Paul Sweeney, and we have a rally on our hands. The S&P getting a nice bid, and some of the tech stocks lead the charge, particularly the Apples, the Microsofts, even the Teslas, Paul.
Yeah, those are have been the leaders in this market over the past decade plus. So it's interesting to see what role they'll play in 2023 to the extent that we get some move up in these markets after a brutal 2022.
Yeah, absolutely brutal. Why are we getting this bid today? Let's ask Abigail Doolittle, who's here to break down the market's move. And we've been worried about the COVID uptick, the expansion of China, and indeed the short-term concerns there. But why the bid today?
Maybe 2 down days in a row, Caroline, the end of the year, folks wanting to buy this awful year, so change it up a little bit, all of it on very, very light volume. You also had those initial jobless claims that came in right on the number, but higher than last week, so maybe some folks taking advantage of the thin volume to take stocks higher as a reason of saying that that's a reason bad news is good news. As you were mentioning, the S&P 500 up 1.5%, the NASDAQ 100 outperforming up more than 2%, Tesla and Apple. Tesla at 1 point soaring. Its best day since July earlier, up 2 days in a row, really off of those lows. And of course, Adam Jonas today coming out and saying that next year could be a re-rating for some of these stocks. That said, it has been a difficult December, and I believe you were just talking with Ed Ludlow about this, but down about 40% in December so far, even with today's rally. On the year at 1 point down 70%. But something to think about, valuation here is much more attractive than people have really been thinking, at least in some ways, given the fact that it's plunged so much. Some of those metrics, a 35-time forward PE, given the fact that you're looking at 60% top-line growth, triple-digit bottom-line growth, big growth numbers next year. Even if they come in, it should still be attractive. Plus, on the car metrics, good ROE, good inventory turnover. All of this is a way of saying that, yes, maybe next year will be a re-rating. Will it be a re-rating for bonds and stocks? Hard to know, but this year we do, of course, have both stocks and bonds down. Bonds down the most since 1999, stocks down the most since 2008. It's going to be interesting to see whether 2023 brings some kind of a reprieve.
All right, great stuff. Abigail Doolittle covering the markets for us here from our Bloomberg Radio studio. We appreciate that. Big day in New York City for the cannabis business. We're getting the first legal store opening today. This pet pot shop aims for $1 million a year in revenue. So a big day here in New York City for the cannabis folks. Ken Shea, he's Bloomberg Intelligence. He covers all the consumer stuff, including cannabis for Bloomberg Intelligence. He joins us via Zoom. And Whitney Beatty, Josephine and Billy's Cannabis Speakeasy, joins us via Zoom from Los Angeles. Whitney, love to get with you first here. All right, we'll go to Ken Shea first because he is our rock star as it relates to kind of covering the business of cannabis. Ken, how big is this for New York City, getting its first legal pot shop, and kind of how do you think that's going to evolve in New York?
Yeah, hi, Paul. Happy holidays. Great to see you again. It is really a big deal. I mean, New York is a huge market. It's a highly visible market, and I think a lot of other populous areas in the United States that haven't legalized are going to be watching this closely to see how it pulls it off, how it does. New York's a large market, and it has high hopes, and no pun intended. It looks to its neighbor, New Jersey. New Jersey, legalized recreational only back in April. It's already up to a $1 billion run rate in sales. New York's got twice the population. So you put the math together, and you have a really big industry out of the gate. The demand is going to be there. This product's been around a long time. Yeah. And so, yeah, all eyes are on New York. It's one of the most visible market to really get a sense of what's going on.
You do some great analysis for us, and we always love it, that sort of bringing together some of the issues that perhaps still the spending bill didn't have the marijuana banking element to it, and we saw a lot of pot stocks fall on the back of that many still say to really grow this industry, they need to be able to get bank loans, they need to be able to get more easier access to capital. But I'm interested in your perspective of why we've already seen the ability when I walk outside of Bloomberg to cross the street, and I can go and get edibles. I can go and buy certain marijuana-related food and consumption. What is that store doing now, and why has it been able to do that ahead of this sort of legalization?
Well, New York is taking a different approach, put it that way, than many markets, and allowing, the social justice theme to allow some flexibility, and put it that way, to some operators that won't exist in many other markets. And that's going to at the consternation of the legal operators. Legal operators say, look, we're paying all these taxes. We're jumping through all these hoops. We're doing a lot of things here. Help us out by enforcing the laws on the books that, you can't have someone down the street selling it legally and avoiding taxes if the regulated entities are going to compete well. So that's really going to be a key issue going forward. And it also may, also discourage some other big entities from getting into the New York market until they enforce those rules.
Really interesting that you bring up social equity there, and we thank you so much, Ken Shea, of course, of Bloomberg Intelligence. We want to dovetail into that exact point, because what's so interesting with this development of the cannabis market here in New York is that Kathy Hochul and the governor have been trying to think about how it's ensured that the people who've in the past perhaps been targeted for cannabis infractions now actually manage to benefit from the legalization with jobs, with opportunity. And they've set up a $200 million New York Social Equity Cannabis Investment Fund. This is something that we've seen perhaps in Illinois as it started to embrace legalization. How can they try to foster growth, particularly among people of color, ensure that they're leading businesses? It's not always worked that well of late within the licensing process, particularly in Illinois. Let's talk about how it's working in LA. We've got a perfect guest. Whitney Beatty is with us, founder and CEO of Josephine and Billy's. It's the first cannabis speakeasy in the US that's for women of color, targeted there. You took checks from Jay-Z, cannabis investor, the parent company as well. Just talk to us about your journey, Whitney. How have you found yourself able to lead this sort of a business?
I mean, it has definitely not been easy to get into this space. And particularly, even with social equity being what it is, it's really hard for us without having access to that capital to grow our businesses. I mean, I applied for social equity in Los Angeles in 2019. Our program here had a lot of delays, and unfortunately we were required to hold property through all of those delays, which was incredibly difficult for us, to sit and pay for 2 years, on a place that we were not allowed to sell cannabis out of. That really hurt us, especially when we're talking about a population that is, the idea of equity is that communities of color were disproportionately disenfranchised by the war on drugs and thus deserve prioritization in legalization. And so that really kind of drained our funding. And when we're talking about especially equity businesses, we don't have that much access to capital, as you mentioned. I mean, I can't go down and get a loan from Bank of America. The SBA isn't offering loans. We're stuck in a world where we have to be able to raise money from either angel investors, which a lot of people of color don't have in their networks, or VCs. And we know that VCs are giving about 2% of their money to women-led businesses and 0.0006% to women of color. And that is, abysmal numbers. It makes it really hard for us to compete.
So Whitney, just give us a sense of kind of where your business is now. What's the outlook as you look ahead to the new year?
I mean, it becomes really difficult for us on a couple of different levels. It's, being able to have raised enough money. We've raised $1 million, but really we need 2 in order to be able to compete with big MSOs that are there on the market. It's also really difficult for us because of the tax structure here. As a legal cannabis business, I can't write anything off because of 280E. So that overhead is sitting on us. And also I'm competing again with the illicit market. If I'm going to have to, they're charging you $100 and I have to charge you $137 because we have 37% tax here, it makes it less attractive for people to be able to buy from the legal market. And it also makes it less attractive for those people in the illicit market to come into the legal market. So we're concerned about what the future looks like, especially as we see the price of plant fall, tremendously. I mean, we're talking about, pounds that were going for $3,500, $4,000 now, sub $500. So what we were looking at as we're building projections in 2020 is not necessarily what we're seeing now in 2022.
Whitney, a lot of the obstacles you outlined there so eloquently, what about some of the help you therefore need? Is it about cracking down on the illegal side of the businesses coming from the government? Is it about having more funds coming from government, as we're seeing here in New York, to be able to back businesses such as yours? Is it about educating VCs, about angel investors to ensure that you are raising 2 million rather than 1?
It's about all of those things. We definitely have to see taxes go down. It's critical, and we need the community to understand why that is so important. A lot of people sold legalization on the ability to tax the heck out of us, but that's not going to allow this industry to survive. We have to see more capital coming into this space and have access to it for these equity businesses, whether that means that the state allows us to be able to have more grant programs, more loan programs. I'm happy to take a loan. The fact is that I cannot do that. We don't have access to that. We definitely need more education on the VC side. Businesses ran by women, businesses ran by Black women. We do have great success rates. We do have the skill set out there. We just don't have the access to capital in order to compete with someone who is sitting on millions of dollars, who can definitely drop the price of an ape and wait us out as we die and then collect those licenses up. So we need all of those things in line. And also for equity in particular, we need technical assistance, within the community, because the cannabis industry is highly regulated. I'm dealing with compliance issues on a daily basis. So if we don't have the skill set, especially because there's not necessarily a roadmap. This industry is incredibly new. So being able to have a technical assistance that's going to allow people to be able to be compliant and be successful in their businesses is what it's going to take for equity businesses to succeed.
So Whitney, it sounds like an extraordinarily challenging outlook. Is there any relief that you see out there? What keeps you going?
What keeps me going is are the people that I'm helping at the end of the day. I came to cannabis because I had a doctor who suggested that I try it to deal with anxiety. I didn't use it when I was younger. Nancy Reagan told me to say no to drugs. I believe her. So it took me a while to come to this space, and I had to do a lot of research on the plant, learning about how to use it effectively, and also about why I felt so negatively about it. And I didn't want the next person to have to do that much research or have such a hard time, because what we know for sure is that, especially when we're talking about our demographic, women are more stressed than men, and women of color are the most stressed cohort out there, and yet we have the least access to health care. And when we do have health care, we know that the doctors aren't necessarily listening to us. That's what the data is saying, and we might not have money to cover that. So being able to have safe access to affordable cannabis within our communities, also public health is being able to offer that to people with anxiety, with PTSD, right, with all the things that we know that cannabis is good for. And so waking up and knowing that I'm offering that in my community and giving them education that isn't available elsewhere is what keeps me moving within this space.
All right, Whitney, we wish you the best of luck. Challenging situation, but some interesting opportunities out there. Whitney Beatty, Josephine and Billy's Cannabis Speakeasy, joining us via Zoom from Los Angeles. Right now, let's get world and national news with Lisa Mateo in New York.
Hey, Paul, we're starting with the war in Ukraine. Russia ruling out peace talks with Ukraine and says it won't give up despite setbacks in the battlefield. Foreign Minister Sergei Lavrov also told a state-run news service the Kremlin will not discuss Ukraine's demands that it withdraw from occupied lands and pay reparations. The war is now in its 11th month. Taiwan Semiconductor Manufacturing has kicked off mass production of next-generation chips. That ensures the island remains a center of a critical technology that's fought over by the U.S. and China. TSMC is the primary chip maker for Apple. And it was one of the more significant disruptions to Twitter since Elon Musk took over the service. The platform has restored service hours after thousands of users worldwide reported glitches and other issues. Musk said Twitter had rolled out changes to its server architecture. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg. Caroline.
Lisa, thanks so much. Let's have a quick check on the broader markets as we speak, because the rally is extending. Up 46 points, let's call it, on the NASDAQ. We're up 2.4%. Yes, volumes are muted, but still, there is some juice to this buying, it would seem. 1.6% higher on the S&P. Even the Dow is up more than almost a percentage point. Europe still getting a bit as well. We're currently seeing the DAX up 0.9%. Similar moves across the Stock 600. Really, we're seeing Spain managing to get a bit of a bid, as well as Italy, the FTSE MIB, up more than a percentage point at the moment. Asia didn't have such a pleasant day of trade, and they were down, but actually the Japanese yen, in terms of FX pool, is doing particularly well on the day. In fact, dollar is weaker on the back of that jobless claims data.
Yeah, exactly right. And we're seeing that give it a little bit of a lift here to some of these risk assets. And again, on the U.S. equity markets, we'll take it after 2 days of decline starting the week, but again, muted volumes.
Tell you where continues perhaps to be a key concern is your travel plans. What about Southwest, the meltdown there, the stranded passengers? What about, well, whether you want to be staying in a home? So you have a key CEO next. This is Bloomberg.
The tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to Bloomberg Markets Live. We are going cross radio, cross TV. We are cross platform today with one Paul Sweeney, Caroline Hyde. We've got a stock rally on our hands. We're seeing most industry groups on the higher side. We're led higher by technology, but still we try and digest some of the changes to the rules in which we are allowed to travel now. I think still the world's trying to understand how China's reopening story affects the longer-term economic growth, but also our ability to start to see the Chinese buyer come back to the US, come back to New York, go back to London, and indeed whether it's safe to do so.
You know, I was in Midtown yesterday, walking around, and lots of international tourists, mostly European. I did not see, obviously, a lot of Asian tourists, but the Europeans are back, the tourists are back to Midtown Manhattan. That's a good thing. Now we have to, I think the world has to figure out a way to assimilate the Chinese travelers back into the global, movement of folks.
What does that do for your costly steak?
I know,
Inflationary
exactly,
pressure, everyone's
exactly.
a little bit worried,
Yeah.
and I'm liking to see these Europeans coming even with a strong dollar.
Yes, exactly. Exactly right. All right, let's bring in Madison Mills. She's joined us once again here in our Bloomberg radio studio. I'm looking at Southwest Airlines. The stock's up today, 3.4%.
Yep.
It's down 22% year to date, but still a little bit of better news coming out of Southwest.
A little bit of correction there in the markets this morning. We are seeing, though, for the travelers, still some bad news. Thursday, still over 2,300 flights canceled by Southwest today. I spoke with one passenger who tried to rebook her flight. She was not able to get a new one until February on Southwest, so she went ahead and paid $1,500 out of pocket to get on Delta.
Okay. And so overall, are we starting to see, well, it sounds like not much reprieve and still just financial outlay?
Yeah, not much reprieve for those Southwest travelers. There is some hope, though, heading into the weekend that the warmer weather is going to lead to a little bit of correction with all of these flights. But it just really points to this bigger issue with Southwest of kind of how their systems are run. And this is what I think is going to be the big story and the big question for CEO Bob Jordan heading out of this issue, because Southwest continues to run on that point-to-point system, which does help them keep a healthy balance sheet. It keeps costs down, but it's really difficult to run when there's any sort of unforeseen circumstances like the extreme weather we saw this week.
Oh, we can't control the weather. We're not able to control the reopening of certain economies either, but we thank Madison Mills, of course, keeping us up to date with what's happening for you in the skies. Let's talk about, well, when you're on your aeroplane, you've managed to make it to the destination of choice. How are you feeling? How are you spending? Where are you going to spend it? Well, is it a hotel group? We're pleased to welcome a key CEO from that space, Larry Kukulik. He's president and CEO of BWH Hotel Group. You know it, of course, of Best Western Hotels and Resorts, but also you're talking economy, mid-scale, upscale, upper scale. I'm liking to see that that's a turn of phrase, but also luxury and boutique segments. Like, you've got 18 brands, I think it is, Larry. Are they all full? Where are you seeing the most exuberance as we head into the new year?
Well, we're seeing exuberance across all of our markets, of course. In segments. The demand for travel is robust. We are experiencing a tremendously successful 2022 holiday season, and we anticipate and are projecting our most successful New Year's weekend ever as well.
So, Larry, talk to us about the day-to-day operations. I'm going to go to something that I've noticed. No, service to service the room for 3-4 days. Now, I know that was a byproduct of the pandemic. Are we going to get daily housekeeping back into the business model, or is the industry moved on to something that's maybe every 2 days, every 3 days, every 4 days?
Yeah, at Best Western, we encourage our hoteliers to offer everyday service. Guests have the option to request that they don't have that service if they have their personal concerns. But we understand that guests have diverse requests and requirements with regard to overnight service. It's not just the COVID, I'll call it a COVID result. You also see the hotel industry having labor challenges, which is also influencing that overnight service that's being offered. But we encourage our hoteliers to offer overnight service.
So one of the things, Larry, as we think about travel, is the leisure travel seemed to come back pretty darn quickly. Business travel, a little bit less so. What are you seeing from your perspective for business travel as you head into 23?
And we're focused on midweek business, which is that business travel. While it has lagged leisure travel coming back, we're seeing that businesses recognize the importance of face-to-face meetings, conferences, and while it's been, I'll call it, lagging the leisure return, we're looking forward to it coming back in 2023 to pre-pandemic levels. And what you also have to consider is there's this push for international travel as well, which plays an important role with regard to midweek and international business travel.
Let's talk about that international travel. Let's talk about the news that is so fresh this week, the fact that China has basically done a massive U-turn and is now going against its COVID-0 policy. They now want to be issuing passports, issuing an ability to not only enter China, but also for the Chinese people to be back in the skies and visiting, well, New York, London, different international destinations. Are you excited, trepidation? What does that mean for you and your business?
Well, we're excited about it. We think Asia is a tremendous opportunity for the rebound, and Chinese travel plays a major role in that. You know, we understand China has lessened its restrictions, but you also have to understand, while you can be optimistic in that regard, there will be some, I call it, compression associated with the lessening of those restrictions, and you can see that happening already with the United States, India, Japan, Italy, putting in place, I'll call them testing requirements with regard to inbound Chinese travel. So while it should have a positive impact on international business travel and international leisure travel, you have to be cautiously optimistic because there will be countries that are concerned with regard to the health, welfare, and safety of their citizens.
What is number one on your sort of consumers' concerns or hopes right now? Is it that they're worried about COVID? Is it more the inflationary pressures? How are you expecting that to impact post-New Year? Are we going to be as desirous to get out to spend as potentially this global recession starts to bite?
We think there's still that pent-up demand post the challenges of the pandemic that hasn't yet been unleashed. So we are optimistic about travel in 2023. Again, you have to be cautious with regard to the impact of the Ukraine war, inflation, fear of a recession, which can influence consumer confidence. There's supply challenges, labor challenges. There are a lot of unknowns that can, I'll call it, influence outcome. But we're optimistic because what we have seen is, by way of example, January, February, and March exceeding pre-pandemic performance with regard to occupancy and also with regard to rate, average daily rate. So while we're very confident that we have early signs of a tremendous 2023, you have to continue to monitor the pressures on that confidence that I just mentioned.
Larry, you mentioned labor before. I'd love to get a sense of just kind of what you're experiencing right now across your hotel groups. Is those labor challenges, are they moderating, or is this something you're baking into your model for 23?
I wouldn't say baking it into our model, but what we're doing is trying to help our hoteliers as much as we can with regard to those labor challenges by providing them assistance, training, and support with regard to those hoteliers becoming an employer of choice through a program like the Because We Care program, and Best Western being a family of independent hotel owners that recognize the importance of being good citizens in their communities. And as a result of that, they can become that employer of choice that can successfully overcome labor challenges.
Larry, which hotel are you going to be at for New Year?
I'm going to be at home, thank you.
That's a non-rocking the boat answer. We thank you. Have a wonderful time at home celebrating in this new year, and one that seems pretty optimistic, it would seem. Larry Kukulik.
Thank you so much. Happy holidays to you and to yours.
And you, Larry Kukulik, CEO there, of course, of the Best Western Hotels Group, BWH, as you know it. Let's talk a little bit about these markets because, well, optimism from Larry and optimism in the markets. It feels as though there's a bid on and people wanting to put money to work. Thin volumes, but 2.4% higher on the NASDAQ today, Paul.
Yeah, good stuff. We'll take it after the first couple of days, which was a little bit in the red here. So we'll have to see how people are setting themselves up for 2023. I think people want to feel cautiously optimistic about putting some risk back into their portfolio. The fixed income markets were just brutal in 2022 with some unprecedented losses. A lot of strategists are saying it's time to dip your toes back into the bond market.
Oh, the strategists, not many of them have been right in 2022. So I wonder how they reclaim some of their battered egos and perhaps some of their reputations going into 2023. We're going to be discussing that amazing big take on Bloomberg a little bit later. But let's have a look at what's happening in Europe at the moment. CAC 40 currently up 0.9%. The DAX is up 0.9%. I mean, basically volumes are off by half than your usual average. The FTSE clinging on to gains. We're up 10 points there. That's 0.1% higher. We anticipate the European close in a moment. Dean Turner's joining us from UBS. This is Bloomberg.
AI is the chance of humankind to really understand itself. How much of that is true? How confident? Did you actually overachieve? Did you, back then realize that we would be using AI in many different jobs? Was it slower or faster than you thought at the time?
I think if I had a 35 or 40-year prediction task, I would have been more or less on track as to where we are today. But I would have predicted steady linear increase over time. But instead, the field had very minimal improvements until the last 5 or 10 years. Then it really took off. I think we ended up in the right place, but I was very wrong about the trajectory. To this date, we still know very little about how the brain works, but these machines are getting ever more powerful. And I feel in some sense, we did end up learning what human intelligence is by learning what it is not. If we exclude all the things machines can do better than us as what makes us unique in our human intelligence, then now we can rule out many, many things because AI or machine learning has become so good at so many things that what's left must be the key aspects of human intelligence.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Countdown to the Close.
Welcome to Bloomberg Crypto.
Big, expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the U.S. are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
From New York City to our audiences worldwide, we welcome you to a global simulcast, TV, radio. We are pleased to do it this Bloomberg Markets Live holiday trading day for you. Paul Sweeney is alongside me, Caroline Hyde, and, well, I mean, some optimism. Volumes muted, down about 16% in terms of volumes on the NASDAQ, but it is ripping up 2.5% on the day, Paul.
Yeah, tech stocks leading the way. It's nice to see. They've been the leaders in the past. A lot of folks are questioning what role tech stocks will headwinds from recessionary concerns and the valuations, of course. So the question is, how will tech behave in this market in 23?
And what really changes the narrative from yesterday, where we were cautious, selling off a little bit, to today's buying? I mean, the jobless claims, I suppose, came in exactly as had been anticipated, which is always nice.
Well, I'm going to quote Vince Signorella from Bloomberg Squawk. It's the machines. It's the algos.
Yeah.
I have no idea. So.
Is it technology talking?
Right.
Meanwhile, overall, we are also seeing like the continued evolution, shall we say, of the narrative around China's reopening, what it means for the global economy, what it means in the near term as to whether these new desirous population are wanting to get out there, travel, spend, maybe the inflationary pressures that it adds to US, the UK, and Europe, but also, well, the ability for them to access these sorts of countries. We know Japan, we know the UK, we know the US, now eyeing ways in which perhaps testing is still necessary for the Chinese traveler as they start to see their economy reopen. Let's talk about all of this, the COVID testing, the Chinese travelers, of course, what this means for the hotels, the shops, the retailing that could be upon us in this new reopened world. Justina Lee, I'm pleased to say, is over in London talking about all of this for us. And Justina, get us up to speed. What are the latest news tidbits that we've got in terms of how countries are addressing a very pent-up spending Chinese consumer right now?
Yeah, I mean, it does feel like a little bit like a blast from the past. I mean, the past few days, we've seen headlines about countries like Italy and the U.S. requiring COVID tests against, from Chinese travelers again. But, at the same time, the EU health officials have kind of taken another path by saying that they're opposed to these travel restrictions. And I think this really is a big question for the global economy right now, because obviously a lot of investors were looking forward to China reopening. But now it does seem like at least there will be, no gain without some pain first, because for now, I mean, Chinese consumers are not going out of their house, and there have been new supply chain disruptions from people falling sick, and just generally Chinese people being very worried about catching the virus.
Yeah, not surprising, Justine. I wonder that, the role that the Chinese government is playing here. If I were a U.S. official responsible for, immigration into this country, I think I'd pick up the phone and call my counterpart in China and say, hey guys, can you help us out a little bit? Like maybe require people that are going to travel outside of your country to be vaccinated? I mean, help us out a little bit here. Do we know if there's what the kind of the communication is, the dialogue is between China and maybe other countries?
Yeah, we really know very little about that. And I think there's especially been very strong concerns over this situation in China, because the data that's coming out of there don't seem to be particularly transparent. I mean, there have been a lot of worries about, the infection numbers now that they're no longer requiring PCR tests. And so it's really hard to get a hold of, how many people are getting infected every day. And at the same time, they've recently changed the definition of COVID fatalities. So even the death numbers are now not exactly easy to compare versus history or versus other countries. But China's CDC did say, today that they will start calculating excess deaths. So hopefully we will get a little bit more clarity around, the number of deaths out of China.
All right, Justina, we really appreciate getting some thoughts from you. Justina Lee, Bloomberg News in our London studio, giving us the latest on China and the reopening of China. So we'll keep an eye on that, because that is changing. It is a fluid situation, as they say, changing on a daily basis. All right, let's switch gears. Let's take a look at the U.S. and European economy here as we head into 2023. A lot of challenges that are common to other parts of the world, but of course they also have the geopolitical issues in Ukraine as well, and that's impacting kind of, I think, forecast for a lot of folks and outlook for 2023. We're going to check in today with Dean Turner. He is the Chief Eurozone and UK economist for UBS Global Wealth Management, joining us from London via Zoom. Dean, thanks so much for joining us here. I guess the economic discussion du jour is recession, no recession, how deep will it be? For the UK and Eurozone, what's your call here for 23?
Well, as things stand, we still expect to see a recession in both the Eurozone and the UK. I wouldn't be expecting a particularly deep recession, peak to trough of somewhere around 1%. But that said, I think a couple of things have changed in the last few weeks. The first being that incoming data has actually been a bit better than what we were expecting, certainly. So, that places some upside risks, certainly to the fourth quarter numbers, perhaps in the first quarter as well. And I think the other thing that, as you mentioned, the war in Ukraine and the impact that that's had on our economies via the energy price. I find it very interesting at the moment, if you're looking at the charts for gas prices in particular, how far they've fallen in recent weeks. And if that is continued, then that probably places another bit of upside risk in terms of the growth forecast. So as things stand, I'd still be looking for a slowdown, but I think we have to accept that slowdown may be even shallower than what we previously thought.
How interesting. Just tell us about how European economies, the UK economy, are getting a grips of the inflation and what might be soothing a little bit, as you say, when gas prices start to fall. We have seen an awful lot of labour tension at the moment, most acutely in the UK, as we so know well, but also in Europe as well. I mean, we're starting to see it here in the US as well. Strike action. How much are we likely to see that being an implication, a slowdown in economies, or is this really something more that grabs the media headlines rather than impacts economies more generally?
I think we have to say that the economic impact so far has been limited, and it would be my expectation that going forward, we will see more industrial action. I think that's a given. But is it going to be enough to cause a wider shock to the labour market? I don't think that's the case. This is not the 1970s. The percentage of workers who are unionised is much less today. Moreover, the bargaining position of workers it seems to still be relatively weak. And the reason I say that is that yes, we are seeing wage increases coming through in the data. Workers are successfully negotiating a pay rise, but they're still negotiating a real terms pay cut. So until that changes, I'm reluctant to change my outlook in terms of the impact that some of the labour market tightness we're seeing will have over the medium term. It's here for now, but I wouldn't expect it to build into something a problem over the longer term.
Hey, Dean, we actually had the Bank of Japan just a week or so ago kind of throw in the towel, if you will, and say, okay, we're willing to let rates go higher following, the rest of the central banks around the world. The Bank of England, the European Central Bank, what's your outlook for kind of their actions in going into the new year?
I still think we should be expecting that the central banks are going to increase rates as we go through the first quarter. Certainly from the ECB's perspective, I think that meeting in December provided us all with a number of surprises there. And if you take them at their word, interest rates are going to 3% at least in the Eurozone. I would also argue the same for the UK. We're probably looking at rates going north of 4% in the first quarter of next year. But that said, we are against this backdrop of economic growth is slowing, inflation pressures are easing. Two factors are driving that. Let's be clear about this. The first is the base effects that we're seeing in terms of higher energy prices from last year are starting to weigh down on headline indices, but also weaker demand. I find it interesting when we're looking at some of the survey data, which, survey data we have to take with as a certain degree of caution. But I do find it interesting that, companies are already flagging a reluctance on the behalf of consumers to accept further price rises at the current rate. So that weaker demand outlook, I think, is going to compound that downward pressure on inflation. So I'd still be of the view that the peak is probably we're closer to the peak, the end of this hiking cycle than we are the beginning, accepted there's a little bit of uncertainty around where we're going. But I think market pricing is probably still a little bit too aggressive for both the Eurozone and the UK. Markets looking for 3.5%. We suspect that the ECB stops closer to 3%.
So we've sort of talked about almost the mandate of the central banks at the moment, the inflationary pressures that we've talked about, the labour that we've talked about, and indeed where you see the central bank's actions going. What about more broadly, therefore, the resilience, the feeling in the market that you get in terms of opportunities to be putting money to work, and indeed whether the economies are likely to weather a storm better or not? Do you think overall we are starting to see people see value at this time, or really is sentiment and just still on the floor?
Well, as you take the surveys, some of the investor surveys at face value, it would still seem that most investors are still pretty cautious, and indeed our own positioning is still quite a cautious one. We're focused on defensive, focused on value, focused on protecting for the downside, because as things stand from current levels, we think there's probably still quite a high chance that we do see further volatility. But that said, what is starting to come through, we think, is that sentiment is likely to turn sooner rather than later.
And then are companies looking as strong as they are perhaps here in the US? Have they got the right balance sheets in place to weather it?
I think across the board, if I'm looking at macro data, and my sense is that corporate leverage, for example, isn't particularly high or at worrisome levels. The other thing I'd note as well is that profit margins are holding up and being far more resilient than most people are expecting. So yeah, perhaps there is a bit of upside risk there, but short term, we still think it's better to be positioned a bit more defensively and a bit more cautiously in these markets.
All right, Dean, great stuff. We really appreciate you taking the time. Dean Turner, Chief Eurozone and UK Economist at UBS Global Wealth Management. With our news in New York City, let's go to Lisa Matteo.
All right, Paul, a few travel changes you should be aware of. The U.S. and Italy have joined an increasing number of nations requiring COVID tests from travelers from China. And they're responding to the surge in infections after Beijing reversed its COVID-0 restrictions. Italy didn't find any new COVID mutations in recent arrivals from China who tested positive. That's a big relief for health officials. Russia is ruling out peace talks with Ukraine and says it won't give up despite setbacks on the battlefield. Foreign Minister Sergei Lavrov also told a state-run news service the Kremlin will not discuss Ukraine's demands that it withdrew from occupied lands and pay reparations. The war's now in its 11th month. In the UK, consumers vow to cut back on restaurant meals and non-essential shopping next year. That's according to a poll from consulting firm KPMG. Now, it found that people feel the need to reduce spending and save more because of inflation. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Matteo. This is Bloomberg. Caroline.
Lisa, thank you. Let's have a quick check on these markets more broadly at the moment, because, well, in amongst all the changing news as to whether you can travel or you can't, and what's going to be occurring in terms of the reopening of China, buoyancy strikes us in terms of a desire to be buying into stocks at least, and indeed, well, maybe a little bit more calmness on the bond market, because the last few days it does feel it's the bond market that's changed the direction of trade, Paul.
Yeah, it looks a little bit like that. I mean, here, looking at the yields here, pulling back just a little bit. We've got the 10-year Treasury off about 3 basis points, 3.85 on your 10-year, and we'll compare that to the 2-year 4.38. So you still got some pretty meaningful inversion there on the 2s, 10s, but it's been there for so long. I kind of feel like its predictability is kind of losing some steam here, because when I listen to the bond geeks like Lisa Abramowitz, she says when you get that 2-10 inversion, you're going to get a recession. I'm like, I'm still waiting for it. So, so we'll see how it goes there, but we're starting to pay attention to that.
Yeah, I mean, the amount of calls for some sort of recession, but albeit a shallow one, are still starting to build. I'm looking at an FX market that is significantly dollar weaker on the day. This comes on the back of the jobless claims data that came out bang in line with what we had expected, showing that, yes, job claims are picking up a little bit, but in general, we have such resiliency in this jobs market in the United States. We see the Japanese yen, the outperformer against the US dollar when you're looking at G10 currencies, having its best day since December the 20th. We've got so much more to come in terms of those job cuts at Goldman. From New York, this is Bloomberg.
you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
.16 a.m. here in New York, 4:16, that means over in Europe, and we're anticipating the European market close right here on Bloomberg Markets Live, a simulcast radio TV. Paul Sweeney and Caroline Hyde. I'm looking at a European market that trades higher overall. The CAC 40 up almost a percentage point. The DAX also up to similar levels. We've got a bid under the US stocks as well, Paul. And this, as we still continue to try and understand just how difficult a year 2022 was for every part of your asset class.
For every part, the 60-40 portfolio that we all grew up on, that didn't work for you.
Neither did crypto.
No, neither did crypto as well. So, but the bonds, some really unprecedented underperformance in 2022. Hopefully better next year.
Yeah, we're getting a bit of a bid on the long end of the Treasury curve today, less so on the front end, so that inversion continues. But let's have a little look at what's happening in terms of really what the market participants are anticipating, what overall you're seeing perhaps the CEOs of big banks that have seen such volatility in the market and have dined out on it. Let's say in 2021, they had a spectacular year amid the volatility. In 2022, perhaps it cuts both ways. We're understanding, of course, that David Solomon, Goldman Sachs, is overall warning a little bit about job cuts on their way in his traditional year-end message, of course. He said that the firm is working on a new round of reductions that will be unveiled in a matter of weeks. Now, earlier in previous month, this December, Sonali Basak caught up with the CEO, David Solomon, of course, of Goldman Sachs, and he was speaking at the US Financial Services Conference in New York City. Let's have a little listen about his caution then.
We're at a very uncertain time, given we're changing monetary and economic conditions very, very quickly. And that's certainly having an impact of slowing down economic activity. And so if you're running a big financial services firm, I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization. I think you have to expect that activity levels are going to be more constrained in a tougher economic environment. So we have businesses that are very, very correlated to economic growth in the world. And we're predicting economic growth will slow. Our economists predict 1.9% economic growth around the world in 2023, which is obviously slowing growth. And the big question is, as central banks tighten monetary conditions and try to control inflation, can they do that and orchestrate some sort of a soft landing? And I think that's still uncertain. I think there's a possibility of that, but I certainly think we could see a recession in 2023 also. And so I think you've got to be cautious and prepare.
How then do you prepare your staff around all of this? It's December, it's the end of the year. People are worried about jobs. People are thinking about jobs. They're thinking about pay as well. It's bonus season coming up. We've reported that you are even thinking about having lower bonuses at businesses that will have rising revenue this year. How are you thinking about this? Bring us inside your decision-making process and what you're telling your staff right now.
Well, we operate a business where every single year we have to pay our most important asset, which is our people. It shouldn't be surprising to people watching the performance of the business this year that 2021 was an exceptional year. It was a record year for the firm. It was the highest net revenue year ever for the firm. 2022 is a different year, and so naturally, compensation will be lower. We're still early in the process of making those decisions, but just like every year, we pay for performance, and we will pay people based on the overall performance of the firm, and especially for our senior people, we consider the overall performance of the firm as we go through our compensation process.
How do you balance also, this year you'd reintroduced the natural culling of headcount. The bonus discussion is not just here, it's obviously everywhere on Wall Street. How do you balance that with kind of the story that we saw just a year ago, this talent war that we saw, this booming market for people, and what's happening this year going into next year into tougher times? How do you balance retention as well as those more difficult conversations?
Well, we take a very long-term view with everything we do. And you have to adjust to the environment, and so you make changes around the margin. But at the same point, you take a long-term view, and you try to think about your business over time. We're extremely focused on serving our clients and our core businesses. Our clients have been active, and so it's important for us to strike the right balance in protecting our franchise and making sure that our people are paid for performance. On the other hand, we're in an environment that's a tougher environment broadly. Performance is not as strong, and so we balance that. But we take a long-term view. Our people take a long-term view. But I just made some comments in the Financial Services Forum where I said that I'm surprised by how resilient the competition for talent is. And by the way, this is just not in our industry. You're seeing across the United States and around the world that labor is still relatively tight.
Talent war is not over.
The talent war is I think there's some headwinds given we're changing economic conditions. But the competition for talent is still very, very strong. Now, how that evolves in 2023 is unknown. Certainly, if we have a slower economic environment, it will have an effect. You can see across all industries, not just tech, that people are thinking about their headcount size and they're making, let's say, pruning cuts or adjustments just because they feel more margin pressure coming. So financial services is not immune to that, and I think we all have to watch the environment and make the right long-term decisions for our organizations and for our shareholders.
Whether it's headcount or otherwise, as you think about this kind of tougher economic environment, the uncertainty, do you think Goldman is going to have to pursue another round of cost cuts in any fashion? And if that were to be the case, where could you see them?
Well, we always look at the environment and we always size the firm to the environment. If the environment gets tougher, we will obviously make decisions to size the footprint of the firm appropriately. That can come from slowing down hiring, which we've already done considerably in the second half of the year. And that might also come from pruning in certain areas.
So switching gears a little bit here, kind of broader financial services picture and talent war and whatnot. Last year, fintech, crypto firms booming. I'm curious whether the collapse of FTX is making you think in any fashion differently about crypto as an industry and the ability to potentially invest in some firms, maybe buy some assets here.
Well, I've been very clear on my view around this space. I think the underlying technology of blockchain is extremely interesting. I think there are enormous opportunities for blockchain to play a role in evolving the infrastructure of our financial system. I think there's an enormous amount of friction in the way money moves. I think there are a variety of ways that this technology can be used to allow more participation and inclusive participation in financial activities. I think it can break down barriers. That has nothing to do with Bitcoin or a cryptocurrency. I don't really, offer a view on cryptocurrencies. I think they're highly speculative. They may hold value, they may not. But I'm interested in the underlying technology and how the underlying technology can help serve our clients, our customers, and really take friction out of the financial system and also help make it more accessible.
All right, that was David Solomon, Chairman, Chief Executive Officer of Goldman Sachs, sitting down with Sonali Basak earlier this month, talking about right-sizing the firm that is Goldman Sachs for what has been a difficult 2022 and uncertain 2023. So we've had some more news subsequent to that discussion about culling some of their ranks, and we've been talking about that with Sri Natarajan. He covers Goldman Sachs and a lot of the Wall Street stuff for us at Bloomberg News, and he joins us here in our studio. So Sri, just listening to Mr. Solomon, it kind of sounds like normal course of business. We see the environment we're in, and we're going to size our firm accordingly.
Well, you got to applaud the bank CEOs, right? They're very good at using those agricultural terms: trimming, pruning, culling. But a few weeks after that interview with BTV, which really was the first smoke signal that they were taking serious measures, that they were undertaking a serious review of their footprint, of their headcount, and he was as clear as you can be without actually saying it that they were going to carry out job cuts. Subsequently, of course, we've heard that they are thinking up a plan which could result in up to 4,000 jobs getting cut, or roughly an 8% pullback. The final numbers haven't been decided, and they're still undertaking the review, but David Solomon did come out yesterday and told his stuff in his traditional year-end message. It was less about the New Year greetings and more about the headcount reduction plans, and he said that while they're still undertaking the review, they expect to have an announcement by the first half of January, which is in a couple of weeks, you will be undertaking a fairly serious push. And yes, 8% might not sound like a lot at an investment bank where you've had this traditional year-end exercise that has been a part and parcel of the process. But in the last several years, it hasn't played out that way. Even before the pandemic, it's not like they were cutting the bottom 5%. It was a much smaller amount than before. And therefore, if they do go out and exercise an 8% cut, that will appear larger than what would be considered normal and usual. And even if they underplay it, it will be hard to see how it will not rattle their workforce if it ends up being the 4,000 job cuts, which of course is not set in stone yet.
Shri, we thank you, Sridhar Natarajan. We'll be updating with him, I'm sure, as those actual job cuts occur later in January, and which parts of the business, of course, that they occur in. Meanwhile, let's switch gears. Let's have a quick look at what's happening in the broader markets. For all those people still sat at their desks at Goldman Sachs and trying to make markets in this space, we're seeing 2.4% higher on the Nasdaq, up 1.6% on the S&P 500. And we're seeing Europe, as we had anticipate, of course, a key close for this market on what is almost a penultimate day of trade, up more than a percentage point in France, up almost 1% in Germany. From New York, this is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
It is almost 11:30 here in New York. That means it's 4:30 over in UK trading. European trading, 5:30 as we see. Well, let's wrap up what was the day of the week when we come to these holiday days of trading. Thing Liquidity, Paul Sweeney, Caroline Hine here on our cross-platform simulcast. I'm looking at, well, muted volumes on the FTSE 100 off by 50%. We're down by 51% in terms of volumes for the CAC current, similar for the DAX. But we are seeing some relatively healthy gains across the board. We're up almost a percentage point on both of the German and the French benchmarks in terms of equities. FTSE 100 clings on to a 0.1% higher. The Euro Stoxx 50 overall, therefore, posts 1 percentage point to the upside. We're looking at a bond market that ties up trade and actually yields down mostly across the board on the 10 years for the German, for the French overall. We saw a bit into the bond market, Paul.
Yeah, it's interesting. Everything I know about the European stock markets, I learned from Tim Craighead, who covers strategy for Bloomberg Intelligence in London, and he's always pointed out to me, very lower exposure to technology, therefore, maybe less higher highs, but less lower lows, less swings, less volatility, a little bit in some of the European markets, but so they outperformed the U.S. this year.
Interestingly, on the day, technology is your outperformer in terms of industry groups in the Stoxx 600. Technology up more than 2%, then autos, and actually the only industry group that was in the red was miners after they had a pretty stellar day yesterday on the hopes of China's reopening. But, I mean, we've got so much more to be discussing on the day, and we want to really be looking in on what a headache, Paul, this year has been, whether you're in equities, whether you're in bonds, actually whether you're sort of cross-asset more generally.
Right, exactly right. And that applies to the prognosticators on Wall Street, the strategists. Tough year for them as well. There's no place to hide. Equities down 20%, fixed income off double digits. Not a lot of people saw that. Emily Graffeo joins us here. She covers all that stuff for Bloomberg News. She joins us here in our Bloomberg Radio studio. So, Emily, talk to us about, I don't know, some of the big stars on Wall Street, some of the people that get paid to predict markets. Tough year for them.
Yeah, it was definitely a tough year. My colleagues and I, for our latest Bloomberg News story, took a look at the outlooks that a lot of the sell-side strategists and fund managers were making in the beginning of 2022 and the end of 2021. And what they really got wrong was the call on inflation. The consensus was not that inflation was going to persist. We even had Jerome Powell himself saying inflation was going to be transitory. And so that trickled down into forecasts that maybe we would only get a few interest rate hikes. The consensus around the beginning of 2022 was maybe we'll get 4 25 basis point rate hikes. We got 17. And so that change in expectations led to the losses in stocks and bonds.
That term transitory is going to live for a while, I think.
Haunt many for a long time. So true, Paul. I mean, what's so wonderful about your story is, I mean, I have to say you do a brilliant job at naming and shaming, to be perfectly frank, because there are some key players within this who just got it so hugely wrong, 1,000 points wrong. But to be fair to them, there are a lot of other areas that just completely upended, whether it's the Russia-Ukraine invasion, whether, of course, there's China off again, on again, reopening. But what I thought was some of the best quotes were, of course, those who would wanted to go on the record were those who called it right. And the fact that after a 40-year bull market, it trains you to do weird things right, large part not to be able to see the other side of the coin.
Yeah, the Fed put, so the Wall Street strategists call it, has been alive for a very long time. This decades-long period of low interest rates has meant that you could pretty much always buy the dip in equities because in the longer run, stocks will always go up. And so that reflex seemed like it was really hard to shake for a lot of the strategists this year, even as the Fed came out and said, we're going to be really aggressive. Inflation stayed high. This reflex to just buy the dip and hope for a Fed pivot persisted.
That's
for a
really
long
interesting
time.
you bring that up because Danielle DiMartino Booth, who from Quill Intelligence, someone whose opinion I respect a lot, she comes on our Bloomberg Radio and TV frequently. She said that the Fed went into the year, Mr. Jay Powell, with the intent of killing the Fed put once and for all. Mm-hmm. And she felt like this was a Fed that was intent on being very aggressive against inflation. And that's kind of what the street maybe got wrong, that they didn't gauge how intent this Federal Reserve was to kind of get rid of that Fed put once and for all.
We're starting to see pockets of the market understanding that the Fed put is dead. When you look at the sell side expectations for what the S&P 500 is going to do for 2023, the expectation is for a decline. That's the first time that we've seen the consensus expectation for a decline in the S&P 500 since 1999. So the sell side is getting more bearish on stocks. But when you look at where the swaps market is pricing for the Fed funds rate to be in 2023, they're still expecting a rate cut at some point next year. And the Fed has been very stern in saying they're not going to cut rates. So there still is a little bit of a misunderstanding between the Fed's messaging and what the market wants to think.
And going forward, I mean, what I also think was so eloquently put in your story was we all, well, many of the professional trade pointed and laughed at what happened in 2021. The retail frenzy, the meme stock trading, the retail investor that got it so wrong. Are we now seeing a bit of, you know, lack of schadenfreude and a mea culpa moment, do you think, coming from the professional side of the business?
Yeah, when writing this story, I started to see the parallels, the ultra low interest rates. That's really what propped up the meme stocks, the Shiba Inu, crypto coins, everything that went crazy in 2021. But those rates, that environment also helped prop up the buy the dip, stocks only go up, reflex that the sell side strategists had. Even in the summer of 2022, right before Jackson Hole, there was still this opinion on Wall Street that no, the Fed's gonna go slowly. We're almost at the end of this cycle. We're closer to the end than the beginning, and so just buy the dip. And then, of course, we had a rally, and then it failed.
We keep, was it 4 pivots, so-called pivots that we like to make up in the space, and that the Fed was not for pivoting. We thank you so much, Emily Griffeo. It is a great read. Go and check out The Big Take on Bloomberg.com and on your terminal if you're lucky enough to have one. Meanwhile, well, let's talk about these markets and about the forward-looking element of them. And what do you expect for 2023? I'm pleased to say that Nancy Davis is with us, of course. She's Quadratic Capital Management founder and chief investment officer, friend on Bloomberg TV. Always great to have you on, Nancy. Just talk to us about the upending, that the Federal Reserve, the going so hard, so strong. What do you anticipate for 2023 in terms of the interest rate landscape, and whether or not we will see a dialing back sooner than some anticipate?
Well, the Fed was really the first and the most aggressive of the central banks. I think we've seen the ECB trying to catch up, but the Fed has started the balance sheet reduction with quantitative tightening, and the ECB has not yet. So I think going into 23, we should expect the ECB to announce some type of quantitative tightening, something other than just hitting the gas over and over again with policy rate hikes, which has been kind of the primary tool so far.
I know, Caroline, I was told there was not going to be math on this test, and she's from quadratic capital management. That does not sound good. Nancy, you know, what do you think of the argument that we've seen peak inflation? It's behind us. Prices are coming down. This is a Fed Reserve that can, in fact, pause. Do you think they're there, or are they still very much in, we got to keep this thing under control, we got to stay in front of this?
Well, the market is definitely convinced that inflation is going to fall dramatically. Realized inflation, which is actually what you're seeing with lagging indicators like the CPI, you know, CPI in most of Europe is double digits. In the US, it's still well above the 2% target. But future inflation expectations in the US is really right around 2%, even 1 year forward. So I'd say the Fed has been very effective with convincing the market that they've got this, so that they are going to dramatically reduce inflation in the future. And that disconnect between inflation expectations in the future and realized inflation, which is what's actually happening in the data and what we feel in our day-to-day lives, is that one of the biggest wides that I've ever seen in my career. So, you know, I think it's a question of whether investors believe that the Fed has got this, whether the policy rate hikes are going to be effective, but the market definitely is pricing in inflation to fall dramatically.
Nancy, of course, you've got the quadratic interest rate volatility and inflation hedge.
It just
ETF.
rolls off the tongue, doesn't it?
IVOL really does, though. IVOL. I mean, I feel like I've said all of those words an awful lot of late. Volatility, inflation. What about the hedging of that at the moment? How popular is your ETF still trending to be? How is it positioned going into 2023?
Well, IVOL is long interest rate volatility because we own interest rate options. Whenever you buy an option, you're long vol. So interest rate vol has been performing well in 2022. It's one of the few pockets of things that are, you know, actually trending up, because most inflation expectations have been falling all year, even though realized inflation is still at 40-year highs. So tips have been down. The U.S. yield curve is one of the most inverted levels it's been. It's even lower than it was in the late 80s. So I do think interest rate volatility is going to continue to be well bid as the Fed continues to allow their balance sheet to roll off and bonds to mature. I do think the strong dollar could potentially also be a catalyst to have the yield curve normalize. The Bank of Japan recently came out and widened their ban for yield curve control, which is, I think, a step in the right direction to get things more normal. I think the thing that I love so much about the IVOL ETF is it can benefit from, obviously the recession is really priced in. If we have a recession, that would make bonds bid, it would steepen the yield curve as the Fed hikes get priced in on the front end, or make volatility continue to increase. But it's also a really nice just normalization environment, because if we see people go more risk on in 23 because the consensus is so wildly negative, that could also make the yield curve steepen as investors come out of hiding in their 10-year treasuries and add more risky assets. So I think it's really, really unique because it's not a one-way view about recession or, risk on. It could do well in multiple environments. And that's why I love it so much. And thank you, Caroline, for that, all your support with IVOL for the last 3.5 years.
Hey, Nancy, real quick, 30 seconds. I'm an equity guy, but do I go buy bonds here? I mean, they really underperformed in 2022.
It depends which part of the bond curve. The yield curve is so inverted that if you buy long-dated bonds, you actually get paid less yield to take more risk. I would say go look at IVOL. It's 80% plus in treasuries, and then takes interest rate spread risk. So most investors in fixed income take credit spread risk. It's just a different type of spread risk.
All right, Nancy, great stuff. Really appreciate it. Nancy Davis, I was able to hang with that discussion despite all the quadratic stuff. Nancy Davis, Quadratic Capital Management founder.
I know it way more.
We'll see. Chief investor. All I did was predict earnings and then slap a multiple on it and tell a good story. That was my career. So we appreciate getting some thoughts from Nancy. With our news in New York City, here is Lisa Mateo.
You got me on the quadratic stuff too, Paul. Well, we're starting over in Kosovo right now. Serbs have begun removing road barricades erected in protests against the largely ethnic Albanian government. The move comes after the U.S. and European Union increased pressure on both sides to avert a new Balkan conflict. Years of EU mediation between Serbia and Kosovo have made little progress. Italy's Prime Minister, Giorgia Meloni, says Europe's 2035 ban on combustion engines doesn't make sense for Italy, and it hurts the country's business. The automaker Stellantis, which used to be Fiat, is one of Italy's largest manufacturers. The EU agreed on the ban earlier this year. And Taiwan Semiconductor Manufacturing has kicked off mass production of next-generation chips. That ensures the island remains the center of a critical technology that's fought over by the U.S. and China. TSMC is a primary chip maker for Apple. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg. Caroline.
We thank you, Lisa, as always. Let's have a quick check on what's happening in the rest of these markets at the moment, because we are continuing to see a push higher of 2.6%. We're actually basically at the highs of the day overall as we continue to digest what is a reopening story coming across from China, as we continue to digest what has been a really torrid year. Not only if you've perhaps been on the markets, but also, Paul, if you've been a billionaire on the billionaires list. It's been quite tumultuous there.
It's been a tough year for a lot of our billionaire friends. Some of it is market related. Some of it is self-induced when you think about who was once the richest man in the Bloomberg Billionaire Index.
Yes.
So we'll have that coming up.
Yeah, of course, talking about one Sam Bankman-Fried, who lost a cool $16 billion.
I know. Rich go is the function on the...
And actually what happened? Rich
go.
Exactly. Went poof. Where is it, Sam? We're going to continue to question. From New York, this is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Welcome back to our global simulcast. We are across TV, radio today. Paul Sweeney, Caroline Hyde, and we digest the volatility index that falls on the day. We are back to a 21 handle on the volatility index. So a little bit of calm amid what has been a storm of 2022, but a little bit of buying, particularly in the tech stocks today, Paul.
Yeah, exactly right. Yeah, S&P up about 1.8%. Tech's leading the way. NASDAQ up about 2.6%. Let's see where the action is under the Abigail.
Maybe creating a little bit of that bad news is good news type of a scenario. So that could be some reason that you are seeing some of this buying. And right now we're actually now looking at a Santa rally. We're up about 0.4%.
Can I call out Elon Musk? We've been beating on him. The market's been beating on him. Tesla's up 8.2% today.
It is.
That's a welcome reprieve from what's been just steady selling.
Absolutely. So that stock is heading to its best day since July. So a real reprieve, a stock that's had been down 70% on the year. And I think that some folks are really taking a look at this story, this company, and separating some of the Twitter drama from the Tesla story. Because if you strip out the numbers on Tesla, in some ways you can make the case that they're attractive. We were talking about this in the last hour, that the multiple 34 times, yet there's 60% top line growth. There's triple digit bottom line growth. The car metrics, ROE is very good. Inventory turns. So I think you have some people putting the pencil to the sheet and saying, you know what, this is a good company, and maybe some of the Elon Musk factor has been stripped away. What is it worth? It's worth a buy right now. Technically, it also looks great.
Yeah.
Abs doodle.
Yeah.
Absolutely. Thank you so much for that. And let's talk about Elon Musk. I'm just looking on RichGo. Elon Musk yesterday made $2 billion to the upside because, of course, Tesla rallied a bit yesterday as well. But overall, he's down $138 billion on the year.
That's real money, isn't it?
Well, a lot of it's wrapped up in Tesla stock, but It's real fictitious money that, we worry about a little bit on our 401ks, and that brings a tear to our eye. What on earth he's feeling right now? Let's talk about billionaires more generally for 2022, because across the board it was a pretty tough year, particularly for these founders and these companies that have been forcing higher some of the wealth of these businesses. Devin Pendleton is with us from Bloomberg, who writes about the Bloomberg Billionaires Index and can tell us a little bit how much. We saw Elon Musk for the first time in years fall from the top spot. How is he really the person that we're most focused on for the year in terms of wealth erosion?
There was so many names to choose from this year when you talk about wealth erosion. You saw Elon Musk obviously was the most crazy example because he was down so dramatically, which is a complete reverse of what we've seen the past 2 years when he gained so much money. He really had the biggest fortune almost in historic proportions at the end of 2021. Really, more than all of those gains were erased this year. But it wasn't just Musk. You saw all of the tech billionaires whose fortunes are so concentrated in their companies, like Jeff Bezos, Mark Zuckerberg, Changpeng Zhao, who is a big crypto billionaire. They had incredible losses. The four who I just mentioned right there, $392 billion in personal fortune gone just among those four individuals.
Who is Bernard Arnault? He's number one.
He is. He has quietly become the richest guy in the world this year. In fact, it just happened this month. And Arnaud, he's been around a long time. He's the head of LVMH, which
luxury.
is luxury fortune in the world. So it's somewhat fitting. The world's richest guy is atop his luxury empire. And it's kind of underscores how bad this year has been, and that he became the richest guy in the world this year, and he still lost $16 billion.
All right, I love going to Rich Go. I do it all the time. Somehow you guys are not including me. The math, I'll have to check the math. A lot of red on the screen for this year, except for number 3, Gautam Adani, up $42 billion. He's now number 3.
Yeah, he was a stealth riser this year. And amazing story. He is Indian industrialist, and he really is kind of a coal tycoon. I mean, we're not talking about a lot of coal tycoons anymore. It's a bit of an anachronism, but it's sort of a sign of how the Ukraine war really shifted energy markets, that somebody whose fortune was originated in coal has shot up the wealth rankings. And he's trying to diversify. I mean, he's in everything. He's in media, he's in highways, he's trying to get into green energy through his conglomerate, but his wealth just skyrocketed this year to become the first Asian to rank among the world's 3 richest people.
Well, another person who did quite well out of mining, but a different type of mining, and now perhaps has lost it all, is one Sam Bankman-Fried. You mentioned CZ of Binance and how his wealth has eroded. I mean, one of the most stunning falls from grace has got to be SBF. Talk to us about how his fortune just completely evaporated overnight, basically, it feels like.
Yeah, I mean, that's kind of just the punctuation mark on a crazy year for billionaires. SBF's wealth was at a peak of $26 billion. But it was down to around $16 billion in November when FTX imploded. And obviously that fortune just vanished in less than a week, which was probably the most drastic wealth loss ever in history. I mean, absolutely gone. All that money. It's
and how quickly it vanished was just extraordinary. I've never seen anything like it. It's a story made for the Bloomberg Terminal and the Rich Go function. Devin Pendleton from Bloomberg News joining us, giving us the latest there on a lot of red on that screen for Rich Go when you look at the year-to-date performance and the year-to-date wealth for a lot of these folks. Following up on that Sam Bankman-Fried discussion, let's bring in Hannah Miller from Bloomberg News. Hannah, I guess as it relates to Sam Bankman-Fried, my question is, when does he enter a plea, and what do we think that plea might be?
Yeah, so he's expected to enter a plea on January 3rd, which is next Tuesday. And yeah, there's a lot of questions around what that plea might be. So we already know that Gary Wang, who's his FTX co-founder and the former CTO of FTX, has filed a guilty plea, as has former Alameda CEO Caroline Ellison. They're both cooperating with authorities, and it seems like prosecutors have a pretty strong case that may put pressure on SBF to enter a guilty plea.
Otherwise, Hannah, how is the coverage continuing amid the crypto space in and of itself? How much anger continues to be there? How much, I mean, I have to say, whenever I go onto crypto Twitter, it seems to just be a lot of people hurling abuse at the New York Times and their coverage of it all. But overall, how are we seeing the narrative change for the people who are left building in the space and the people who have been left and robbed of wealth in the space?
It's still very raw right now for the crypto industry. There are FTX customers who still have no idea whether they're going to get their money back. There are definitely people who are angry at sort of the shadow Sam Bankman-Fried has cast over the crypto industry. So, 2023 is going to be this big opportunity for them. How can they turn this narrative around? How can they prove the usefulness and the safety of this technology?
And you mentioned Binance, Hannah. I guess they're now, the leader. I'm not sure how to phrase that, but what is the position of Binance and CZ in this sector right now, and maybe as we think about next year?
Yeah, well, Binance is still the biggest name in crypto right now in terms of exchanges. CZ is one of the biggest faces of the industry. but there is a lot of scrutiny on both Binance and CZ, and people are nervous. So, they're looking to see if the same situation could happen with a different exchange. People are scared right now. So it'll be interesting to see how Binance works to, sort of build an image of trust in the new year.
And tell us how they're trying to do that, because of course we all await regulation, and anyone who's particularly regulated in this space, some of the publicly traded names are all sort of throwing their hands with glee that finally more real regulation will come to bear. But how are they trying to self-regulate in between that sort of void of real lawmaking?
Yeah, well, you still see industry figures stepping up, including CZ, and trying to say that they're willing to work with lawmakers and authorities all around the world. And I think for some crypto leaders, they're trying to be more public and more transparent. Whether it's doing a Twitter space or giving media interviews, and they're trying to show that there may be more of an open book than FTX.
Yeah, certainly trying to almost show some of the math, dare we say it? I might say maths. To actually what's really supporting some of their overall assets and liabilities. We thank you always, Hannah Miller, keeping us up to speed with the latest on SPF and more broadly in crypto. I have to say, these 2 hours always fly by.
Fly by. We had some nice movement upward in the market. Let's see if the Bloomberg Business Week show in the afternoon can continue that momentum. We'll be watching.
Yeah, Balance of Power is up next. We got Angela Stent, author of Putin's World, the senior fellow also at the Brookings Institution, to talk all things the implications of Russia. From New York, this is Bloomberg.
So the inflation environment has been changing a little bit. Inflation's been very low for 25 years. Now people think inflation's coming back. How are you going to deal with that?
I think many of the tools that we've historically used to battle inflation no longer work in the same ways they used to. I think people oftentimes thought of housing as a way, or especially retail and real estate as a way to hedge against inflation. Less and less possible the way we've invested in it. I think commodities similarly have been thought of as a way to hedge against inflation. There are challenges over the long term. Equities have been a hedge against inflation. We will continue to do what we have done in the past, which is build a diversified portfolio where there are many different opportunities that have the possibility of hedging against inflation, because different types of inflation have to be hedged in different ways. So if it's a very quick increase of inflation as opposed to a slow rise of inflation, is it temporary? Is it a long or persistent type of inflation? So for us, I never model myself an economist that can predict where inflation is going. And so what I need to do is build a diversified portfolio where there are different options that can fight the different types of inflation, and to pay close attention to it. And fundamentally, it's done through the equity markets.
The tag on the product may read "Made in the USA," but the sign on the CEO's door often says "Made in India." Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
They've raised their inflation forecast.
Firm and immediate action.
He wants to destroy my country.
Elon Musk to buy Twitter.
Overturned Roe versus Wade.
Boris Johnson will call it Donald quits. Trump's plan to overturn the
Unprecedented search warrant at the home of our former president.
Queen Elizabeth has died.
Xi Jinping got his third consecutive term.
The pound falls to an all-time low.
The shortest ever serving prime minister.
President Biden and Xi shake hands.
FTX filed for bankruptcy.
The red wave that never was.
Protesting his zero COVID policy.
From New York City.
From London, in Sydney.
From Washington.
In Tokyo.
This is Balance of Power with David Weston.
Bloomberg World Headquarters in New York to our television and radio audiences worldwide, welcome to Balance of Power. Well, it's getting to be time to turn the page on 2022 when it comes to the economy and start looking at 2023. We did get some economic numbers out this morning, those jobless claims numbers that basically ticked up just a little bit on the newest jobless claims numbers, but frankly, they're close to historic lows still. To take us through the economy, what we're seeing and what he could anticipate for next year, we welcome now Douglas Holtz-Eakin. He's president of the American Action Forum and former director of the Congressional Budget Office. Doug, Happy New Year, first of all. Thanks so much for being with us.
Thank you. My pleasure.
If this last year was a year we actually admitted we had a big problem with inflation, is next year going to be a year when we fix it?
Oh, I think we can make considerable progress in 2023, but if you think back to when Chairman Powell first announced the sort of tightening strategy way back in March, he talked about getting it done by 2024. I mean, he actually put it 3 years as the time it would take to get back to the target. So when you're thinking about this problem, you can't think about it in quarters or months. You got to think about it in terms of years. If we have the core down to something like 3.5 by the end of 2023, that should be considered a big success.
Well, is the Fed having an effect? Because I read a note this morning, actually, that said it is having an effect on things like housing, goodness knows. Housing has really turned south. Yep. Autos, and some other places. You're starting to see some real effects of the rates.
I think the Fed's having a real impact, no question about it. There's a lot of work left to be done. I thought the reaction to the most recent CPI report was a bit premature spiking of the football. I mean, we still have core essential spending, food, energy, and shelter rising at nearly 9% a year, year over year. That's a big number. If you look at the stance of the Fed, the target rate is still below inflation expectations 1 year out, so we got a negative real target. None of that adds up to having a big success that says we can quit. So the Fed has to stay at this and continue to really focus on service sector inflation, especially the shelter number that is driving the top line much more than the goods. They're having a big impact on the goods market, but this 2022 was the year of services inflation, and 2023 has to be the year they fix it.
So, Doug, the numbers you described show inflation, if that's right, coming down, but still well above that 2% rank. What is the Fed's response likely to be to that? Can they be patient and wait for it to come back, or is there a danger of a policy error here?
There's a real danger of a policy error. The way the Fed has structured its decision-making, it has said that they are not going to, believe economists that it's going to come down. They're going to wait to see a distinct downward turn in measured inflation before they contemplate easing. And they've said repeatedly that the mistake that was made in the late 70s, early 80s under the Volcker Fed was to ease prematurely, and they will not make that mistake. So that just sets you up for a policy error, because the data came in with somewhat of a lag, so you're looking backward to begin with. The shelter number in particular moves slowly. It's probably softer for new rents right now than we're seeing in the measured shelter index. And all of that adds up to a backward-looking approach that says you might over-tighten. I think that's a real risk in 2023.
Well, and it sounds to me like a recession comes along with that risk, does it not?
Yeah. I think a recession does come along with that risk. The thing I'm looking for, unlike most people, is focus on business spending. I mean, people are, I think, taking the wrong lesson away from the pandemic recession, where the household did, in fact, lead us into the recession. That's the only post-war recession where household spending led to the downturn. In every other recession, it's business spending that goes down. Households follow about a quarter or two later. So keep a close eye on CapEx and the CEOs, not the consumer confidence, but the CEO confidence. And there are some issues there, and it's worth watching carefully.
So to some extent, Washington's been spending its time watching the Fed, saying, Fed, good luck to you. We hope you take care of it. Yeah. But what are the possible policy responses from Congress or the administration that might actually make things a bit better?
Look, I'll be honest. I don't think we should look for discretionary fiscal policy out of the U.S. Congress and the administration in response to any recession we might enter in 2023. I mean, it would be mild. The Fed has the tools to ease quickly. It can stop the quantitative tightening. It can lower the target rates. It can move much more quickly and nimbly than any Congress and administration can. And I think if you reflect back, among the best years of growth were the 80s and 90s, where we really used fiscal policy to set the incentives for long-run growth, and we let the Fed take care of short-run fluctuations. We got away from that in the 21st century. I'm not exactly sure why, but if you think back, we did discretionary fiscal policy, and 2001, 2002, 2003, 2005, 2008. Again in 2010 with the Recovery Act. Big response with the CARES Act. That's not a uniformly successful record. There's a lot of years of poor performance there. So it's worth thinking hard about whether we want to get back in the business trying to fine-tune the economy.
Well, let me ask you one specific question, because you talked about business spending, and that would be really critically important. We do have these so-called Trump tax cuts that are due to expire.
Right.
That do give incentives, I understand, into business for certainly capital investment.
I think it would be a good idea to make those permanent. I think that the highlight of the 2017 Act was the reforms to business taxation. The multinational taxation really put our firms on an even playing field with other international firms, much more than had been true before. We haven't lost a headquarters since the 2017 reform. I mean, this sort of speaks volumes for how effective that was. And it did give better investment incentives. So I think getting the R&D expense, getting the sort of depreciation fixed over the long term, it should be a top priority for this next Congress, would benefit both small and large businesses.
So, Doug, let me also ask you about the debt. It's something you and I talk about periodically. And my sense is it's never quite the right time to deal with it, because we've got some problem right now. We'll deal with that later. When is the time to deal with it? Is there any prospect of actually people trying to address it finally?
Well, I think that really comes down to the White House. To do something on the debt that matters will have to be a bipartisan effort, and the White House leads bipartisan efforts. The best example is the Bipartisan Infrastructure Act, where it really was going to die in the Senate twice, and the president personally resuscitated it, asked the Republicans what they needed in order to sign on, promised not to touch the 2017 Tax Act, which was their ask, and then he also really pressured House Democrats to get on board. That's the White House generating bipartisan legislation. They have to decide if they're going to do that in the next few years, or are they simply going to set up partisan fights and get ready to run for re-election? If they do the latter, we're not going to do anything serious on the debt. It'd be good to get started now, because the big issues, the Medicare Trust Fund, it's going to go bankrupt in 4 or 5 years. The Social Security Trust Fund, a decade out. Those should be dealt with now, so the people who are retiring know the deal as they go into their retirement.
Doug, one last one. Looking forward to next week. Obviously, we have a new Congress. We also, believe it or not, get our first jobs numbers of 2023 on Friday. Tell us about the jobs market, because it seems to be remarkably resilient. Does the Fed need that to weaken some?
Yeah, I mean, I think the thing that gets lost is the sustained high inflation, which has been stubborn, and the hot jobs market are flip sides of the same coin. So we're not going to see the wage pressures in the service sector, and thus service sector inflation, come down until the job market cools somewhat. And it has cooled somewhat, but the emphasis on somewhat. We haven't seen any real dramatic slowdown in job creation, any real big jump in initial claims, as you mentioned at the outset, still at historic lows. We haven't even seen the job openings go away the way we thought they would. So the Fed's going to be looking to see if there's any evidence that their efforts have really cooled off the market a little bit.
Okay, Doug, it's always such a pleasure, really informative to have you with us. That is Douglas Holtz-Eakin. Thank you so much. Now, when we talk about jobs, we maybe have to wait till Friday to get the overall numbers, but we know some numbers for Goldman Sachs already, because we had David Solomon come out and say he's going to be laying off a lot of people. To take us through what we know, we welcome now Bloomberg reporter Sri Natarajan, who covers Goldman Sachs for Bloomberg. So, Sri, thanks for being here. So this is sort of a year-end present for Goldman employees.
Right. It's an unfortunately bleak message. You have this traditional message that is sent out by the CEO of the firm, which is really a thank you for all the hard work this year and all the best for next year. But this one turned out to be really focused on the headcount reduction that Goldman Sachs is about to carry out. And perhaps it was the right way to go about it, because a little bit of news that David Solomon did insert into his message was the fact that these layoffs that have been reported a couple of weeks before, which could amount to as many as 4,000 jobs lost at Goldman Sachs, could come in the first half of January, when it's just a matter of weeks away. It makes sense to alert your staff, to let them know that there are some difficult decisions coming down the pike, and that could be very, very soon. Therefore, your traditional year-end greeting was replaced by this dour note, and David Solomon, relative to most other CEOs, and even as economists, has been a little more pessimistic about the trajectory of the economy and about what awaits us in 2023 relative to most other people. And he's pretty much gone out there and said, we need to hope for the best, but prepare for the worst.
Sri, to what extent is this a matter of the Goldman Sachs business model? I mean, does this really reflect what other banks will go through, or is it more because Goldman is so reliant on trading, and trading does have highs and does have lows?
So let's look at what has happened over the last 3 years. Central bank intervention was something that clearly lifted all boats, Wall Street in particular, and Goldman Sachs, most importantly, because of all the big trading and banking powerhouses out there. Goldman is the best at what it does. It gained some market share, and that wasn't the only reason revenue went up so much. There were so many of these other macro factors that helped it. And therefore, you had a 2021 where the revenue went up to almost $60 billion, never heard of before at Goldman Sachs. This year, we're talking about revenue tumbling. But even with that tumble, you are still on track for their second best year ever. However, management still wants to be prudent because investors have turned their focus on costs. They are worried about expense bleed, and you certainly have had some of that at Goldman Sachs, partly related to their own misadventures in trying to become this consumer bank that has not really worked out well. They've had some technology expense bill. They've had some bills tied to integration costs. Now you need to pare that back because to your investors and shareholders, you've set return on equity profitability targets that you're not going to meet. And when they see the numbers that will be unveiled in a matter of weeks, they would like to see that the management is focused on it and ready to do some course correction. And that's why the job cuts are on the table.
Okay, terrific report. Thank you so much for being here, Sri. Really appreciate it. That's Bloomberg's Sri Natarajan, who does cover Goldman Sachs for Bloomberg. And now, to keep you up to date with news from all around the world, we turn to Lisa Mateo, who is here with the first word. Lisa?
Thank you, David. Well, thousands of stranded flyers in the U.S. who are booked on Southwest Airlines may get some relief soon. So far, the carrier has canceled just over 3 dozen flights for Friday. More than 2,300 have been canceled today, about 58% of Southwest's schedule. The airline is trying to recover from disruption caused by winter storms and outdated scheduling technology. Another sign of how the U.S. labor market is staying resilient despite the Fed's aggressive efforts to cool demand. Applications for unemployment benefits rose last week, but remain near historic lows. Initial jobless claims increased by 9,000 to 225,000. That was in line with median forecast. And in Italy, authorities didn't find any new COVID variants among recent arrivals from China who tested positive for the virus. That's a relief for officials worried about fresh health threats. Both Italy and the U.S. have joined an increasing number of nations demanding COVID tests for travelers from China. New York State now has its first legal retail marijuana store. The Housing Works Cannabis Company is celebrating its opening day today in Manhattan's Greenwich Village. Now, Housing Works is a nonprofit that helps the homeless and HIV-positive population. The venture will be a key test of New York's highly regulated adult-use marijuana industry. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg. David.
Thank you so much, Lisa. Well, we've talked about the U.S. economy. Let's turn to China coming up next, as we have news now of releasing from the zero COVID policy and some of the effects of that, and people now trying to test people coming into the country from China. We're going to talk to China expert John Fenby of TS Lombard about exactly what is going on in China. That's coming up next on Balance of Power on Bloomberg Television and on radio.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. We've had a couple of days now with what I would call a head fake from the equity markets as they started out up and then they turned around down. To bring us up to speed on where we are today, we welcome now Abigail Doolittle. So where are we, Abigail?
We're looking at a pretty decent rally, and you and I were talking offline earlier, and we said it felt like it was going to stick. Right now it is. We're closer to session highs. That S&P 500 up 1.9%, the NASDAQ 100 up 2.6%. We have the SOX up 3.2%, and of course, one of the big winners, and we were talking about this stock in detail yesterday, Tesla up for a second day, up 6.5%. Adam Jonas over at Morgan Stanley being positive on that name. You know, maybe one tailwind outside of Tesla, because that is sort of like a risk-on, risk-off stock, but maybe another impetus for buyers today. We had jobless claims come in 9,000 higher than the previous week. So maybe some investors on this thin volume seeing that as bad news, turning it into good news for stocks.
I was going to ask exactly that question. How thin is the volume? Because this is holiday period, and often during this period, the volume is really substantially below normal.
It has been so below normal, and last time I looked, and actually still sticking right there, down 20% relative to the 20-day average, which has been anemic as well. So I think we're looking at volume. We're looking at true last of the week, holiday week type trading.
Bonds?
Bonds we have right now basically higher in terms of price. The 2-year note's an exception. It's a little bit lower, but that started off of that jobless claims number. And it wasn't just the initial jobless claims, David. We had the continuing claims spike by 40,000 to 1.71 million, suggesting that those who are unemployed are having a harder time getting jobs. So you might, again, have some of these traders or investors on this thin volume, a little bit of hopium, because I have not heard the Federal Reserve say anything about not doing what they're going to say that they're going to do. But every time we have, some kind of eco data that's a little bit weak, maybe some traders take that as a sign that they're not going to be as hardcore as they're suggesting they will be.
Some people might say clutching at straws. As we go into the new year, where's the dollar? Because it had quite a positive run for a long time, and then it started to come off toward the end of the year.
Yeah, it has. At this point, the dollar is up 6%, 6 to 7%. Earlier, it had been up 15%. So that really speaks to the decline. Now, that climb that we had earlier this year, that was really, it was an interesting story because it was accompanying yields shooting higher. So you had the dollar going higher. A lot of times when you have inflation, that's not necessarily the case because your dollar is not going to be worth more. So maybe a little bit of a flight to haven there as well. But in any case, it was a parabolic move higher. Those tend to reverse. Think about oil earlier this year. It reversed as well. That dollar right now, right on critical support. 2023 might be difficult for the dollar. That might actually be good for risk assets.
And finally, China. Let's talk about China. We talked a lot about the U.S. What about China? Because now as they come off of the zero COVID, there's some hope that China will come back. Are we seeing that at all in any equities or markets?
Well, China's really interesting. That might be one of the big opportunities in 2023 if the world's second largest economy truly does reopen. That NASDAQ Golden Dragon Index hugging its 200-day moving average for quite some time. Off of the lows for that index, we are up about 67%, which is really pretty incredible. And those are some of those ADRs that we're so familiar with, like Pinduoduo, Duo, Billy. I know that you love every time I talk about Billy, JD.com. They're fun names, and it's that fresh, that new technology, that economy. And for so many years, up and away. This has been a difficult year, but 2023, again, may be setting up for something different if the Chinese economy really does see some sort of a rebound. That's a big if, but there are some signs that could happen.
Really fascinating. You set us up well. Thank you so much to Abigail Doolittle for that report on the markets. Staying on the subject of China now, as we know, they are coming off their zero COVID policy. Same time, they've got a lot more COVID in the country as a result. In fact, overnight, we heard a number of countries, including the United States, saying, if you want to fly into our country, you better take a test 2 or 3 days before you come in. To take us through what we know about China right now, we welcome now John Femby. He is chairman of the China team at T.S. Lombard. Mr. Femby earlier served as editor of several newspapers, but particularly the South China Morning Post. So thank you so much for being with us. Really appreciate it. What do we know about what's going on inside China right now?
Well, as always, the data out of China is pretty incomplete at the moment. The number of deaths, the number of COVID cases is officially is very, very understated. And there have been leaks that there may be as many as 200 million people infected with COVID. Certainly there's been a loosening up, and as you say, travel will resume on the 8th of January. That's in time for the big spring festival when workers go home traditionally to their villages or towns and celebrate with their family. So we're going to have a lot, I think, of uncertainty in China over the next month or so as to how big the effect of the loosening up on no COVID is going to be.
Jonathan, as you say, that we call it Chinese New Year, is an awfully big event. I'm not sure we can even fully understand just how big it is for China and its families. Do we have any sense of whether people might be more reluctant to travel back to their families because of what's going on with COVID?
It's probable from the very anecdotal partial reports that we're getting that people will actually be more anxious to travel. They haven't been able to go back to their families. This is migrant workers working in the cities in big assembly plants who haven't been able to go back to their village for years now, and they'll probably make the most of any loosening of restrictions.
So, Mr. Femby, there obviously is a big issue with COVID that China is dealing with as best it can, but it's against the backdrop of some more, as I understand it, structural issues that President Xi and China face. Things like demographics, things like the property market, things like the leverage within the country. Take us through what is really holding the Chinese economy back from its traditional fast pace of growth.
Well, China, of course, has grown extremely fast over the last 40, 50 years or so, and that has become a major, major element in the global economic scene. But underlying that growth have been a number of factors which are, let us say, going a bit sour at the moment. The high level of debt, the demographics with fewer young people coming into the workforce, as you said, local governments which have driven much of the growth over the last decades, really in a bad state with expenditure rising and revenue falling, and above all the real estate market, which has been in crisis for at least a year now. And the question is, to what extent the authorities, the government, President Xi Jinping, want to deal with these problems, which will be painful and will mean slowing down economic growth, and to what extent they want to go back to the old stimulus packages that we've had before. And underlying all this is the Chinese consumer, whether the Chinese consumer is willing to spend more and rebalance between consumption and investment, which has been out of kilter for decades now, to give consumption more of a role in pushing growth. But that, as I say, would be a medium to long-term program, which, for political reasons, particularly after the protests we saw a week or so ago against COVID, the political leadership may not want to take that risk.
Mr. Femby, do we have a sense of how President Xi is likely to handle this confluence of issues? Because he is embarking, of course, on his third term over there. It's a critical time. He's got the COVID problem, and he needs to keep the growth going. Do we have a sense of what his plan is?
Well, as always, everything is very opaque in China, and you have to watch all the signs from day to day and not overinterpret them. But the signs are, over the last week or so, there was a big meeting of economic planners in Beijing earlier this month, and the signs from that, such as they are, is that Xi and his colleagues are going for growth again. They're loosening up. They'll be helping out the real estate sector. They'll be helping out local governments. They'll be investing more in infrastructure and just crossing their fingers, if that's what they do, crossing their fingers that consumers will be ready to spend again after the COVID restrictions are lifted.
Just briefly here at the end, what does that say, if anything, about U.S.-China relations?
Well, I think they're going to remain in deep freeze or possibly get worse. As we see it, the U.S. is going to continue to clamp down on technological, high-level tech exports to China, and President Xi, one of his bottom lines is actually to build up what he calls self-reliance from China. That's to say, China making its own things, making its own way. And that will pose questions, of course, for U.S.-China relations, for foreign companies invested in manufacturing in China, and the whole world economy.
Thank you so very much. This has been very helpful. That's Jonathan Fenby, TS Lombard, China Director and Senior Consulting Analyst. Still ahead, we're going to take a look at President Putin, what he may be in store next year. We're going to talk to Angela Sent of the Brookings Institution, and this is Bloomberg.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the U.S. are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. Well, certainly one of the biggest, most important stories of 2022 was Russia's invasion of Ukraine. And sad to say, it is not over yet, not by a long shot. Throughout this, we have turned to an expert in Russia and specifically in Vladimir Putin. She's Angela Stent, senior fellow at the Brookings Institution, and she is the author of Putin's World, Russia Against the West and With the Rest. Angela, happy holidays. Thank you so much for being here. The latest I've seen...
Thank you for having me on your show.
The latest I've seen is another massive set of missile attacks in Kyiv and other places in Ukraine.
David, I'm having trouble hearing you.
Oh, let me talk.
Let me turn up the volume.
Let's try to turn up the volume a little bit. Let's see if the control room can help us. Angela, can you hear me now? I'll try to speak up also.
Yeah, that's great.
Is that better? Okay, great. What I was going to ask about is the latest round of fairly massive missile attacks from Russia against Kyiv and also other locations in Ukraine. Where are we in the war right now, from what you know?
Well, this is a grinding war of attrition. I mean, the Ukrainians have been making gains. They've been taking back territory that the Russians took, but the Russians have retaliated. They're trying to destroy the infrastructure in Ukraine, deprive people of electricity, of heat, of water. And today, this was by far the largest bombardment in Kiev and some of the other cities like Lviv that we've seen in weeks. So the Russians aren't going quietly. They may be doing badly on the battlefield, but they're still using their air power really to try and force the Ukrainians into submission.
Well, are we moving towards stalemate here, Angela, or for that matter, are we in stalemate right now?
I wouldn't describe it as a stalemate because obviously there's bombing going on, there are deaths, there are casualties every day. It's maybe a dynamic stalemate because, as I said, the Ukrainians are still making some gains and the Russians have withdrawn from territories that they controlled before. But we're not quite at a stalemate yet. But we'll have to see what the rest of the winter brings, because I think it'll be much more difficult to prosecute the war for both sides.
There's a long, protracted conflict over there where Russia holds at least some of the territory they had. Does that play to Vladimir Putin's benefit in the long run?
I'm not sure that it does. I mean, the Russians are now demanding that the Ukrainians recognize their annexation of these 4 areas in Ukraine, none of which the Russians completely control. And of course, the Ukrainians are refusing to do that. Russia does still have this advantage in air power at the moment, but it doesn't look as if Putin has any advantage really at the moment, except to keep grinding down the Ukrainian population. And his game plan is still to get the Ukrainians to put pressure on their own government to stop this war because life has become unbearable for them. And then to get the Europeans to say to the United States, you know, the impact of the sanctions and all of this is too difficult for us, and let's force Ukraine to the negotiating table. But we're not there yet. Transatlantic solidarity is still holding on this.
Well, I want to talk about that, and maybe as a way to get to that subject, let's talk about Volodymyr Zelensky, the president of Ukraine, who came to Washington, a fairly memorable visit just before Christmas. And the message he delivered, as I heard it, was pretty loud and clear, which is, look, this is a turning point in 2023, and we need more. We really appreciate what you've done. We need more. And there's a lot of talk about fixed-wing aircraft, much more sophisticated tanks, longer-range missiles. Would that make a substantial difference in the war? And what would Vladimir Putin's reaction be if we provided it?
Well, of course, Putin's reaction is the 64,000 ruble question that no one's sure about. But what Zelensky is quite right. I mean, this is a war not just about Ukraine. It's really about future security, not only in Europe, but globally. It's about the rule of law, about international regimes and things like that. So the Ukrainians do need more. The U.S. is going to supply them with a Patriot, a missile battery. They need more of those. They do need tanks. We have not supplied them with tanks, and neither of the Germans, even though they said that they might. As long as we keep supplying Ukraine, it will be able to push back the Russian army. If we stop doing that, then it will be in a very difficult position. And I think he made a very passionate case. But he was also, of course, talking to our own Republicans in Congress to try and make sure that they understood what the stakes are, because clearly the Ukrainians are worried about what's going to happen in 2023 when the Republicans control the House and appear to be more skeptical about the support for Ukraine.
Which takes us to some of the solidarity you talked about, both across the Atlantic with our NATO allies, but also even within the Congress itself for the Republicans, as you say. Where are the Europeans right now on this? One of the things I hear from Republicans up on the Hill is, you know, we support Ukraine, but the NATO allies are not doing enough. We're doing too much of it.
Well, we're certainly doing more than the Europeans have been doing. But if you look now at the assistance figures, the Europeans are stepping up. They are certainly giving more financial and other kinds of assistance to Ukraine. But we're still supplying the lion's share of the military assistance. And it's a legitimate question on the part of the Republicans. Some European countries are doing more than others. And I think it is something NATO itself, I think, stands in solidarity here. Even the more skeptical members, everyone is united in this. But I think NATO understands that it probably needs to do more militarily to help the Ukrainians to prosecute the war.
I'm going to crib from the title of your book just for a second. Putin, Russia with the West, against the West and with the rest. Let's talk about the rest of the world, something we talked about in the past. We tend to think that the world is all united against what Russia is doing. Not true. Is the rest of the world starting to come the United States' way? And by that, let me focus specifically on China and India.
Right. So the Chinese are still pretty solidly behind Russia. Apparently, Putin tomorrow will have another phone call with Xi Jinping. Last week, Dmitry Medvedev, the former president and prime minister, was in China talking to Xi Jinping. The Chinese have made it clear that they're not happy about talk of possible nuclear escalation. But beyond that, everything they're saying rhetorically is they support Russia and that Russia was provoked into this war, even though, of course, they're not supplying the Russians with weapons and they're not violating the Western sanctions because they got far too great an economic stake in that. The Indians continue, not to criticize Russia too much. Prime Minister Modi did say this isn't a time for war. He canceled a meeting with President Putin. But the Indians are very happily buying a lot of cheap Russian oil at the moment. They're, I think, the #1 customer. So they're being very cautious. So it is a mistake to think that Putin is a pariah on the world stage. He's certainly a pariah in the Western world, but he is not a pariah for many other countries in the Middle East, in Africa, in Latin America. And so I think we have to recognize that going forward, it doesn't really look as if that's going to change very much. Although I saw today that Morocco, for instance, is somewhat changing its views on all of this and moving towards the Western view. I don't know whether that's a harbinger of other things to come.
You mentioned that visit of Mr. Medvedev to Beijing before Christmas. One of the things I took away from that was the reports that President Xi actually was saying, we should get to the bargaining table. Do you read much into that?
Well, I mean, the United States and other countries have hoped that China would be willing to play the role of a serious mediator and try and get both sides to the negotiating table. China has been very reluctant to do that so far. So I don't know whether this was just something rhetorical that President Xi said, or whether the Chinese are really willing to put their money where their mouth is and really get both sides to the table and try and come up with some kind of negotiation. But frankly, this is not the time for negotiation because the Ukrainians aren't going to give up territory, particularly territory that they've now retaken from the Russians. And the Russian official line still is the only way we negotiate with Ukraine is if they surrender, essentially, and accept our annexation of these 4 areas.
When we talk about the war, at least I tend to focus on the military aspects of it. But I wonder from Vladimir Putin's point of view if there's something even more profound here, and that is the very culture of Ukraine, the very history of Ukraine, because there are reports, for example, in the New York Times today, about Russian troops in the areas they occupy really fairly systematically doing away with some of the emblems, statues and things like that of Ukrainian history.
Yes, I mean, Vladimir Putin is insistent that Ukraine isn't a separate nation. It has no right, the Ukrainians have no right to a separate state. There's no such thing as Ukrainians. They're really Russians who are misinformed. And so they're systematically obliterating or trying to obliterate Ukrainian culture. They've looted museums. As you said, they're renaming streets from Ukrainian to Russian names. They have this re-education program in schools now in areas that they occupy where they kind of obliterate for children the idea that there is such a thing as Ukraine and a Ukrainian language and a Ukrainian nation. So this is really part and parcel. It goes back to this essay that he published in 2021, the 5,000 words on why Ukraine isn't a separate nation and Ukrainians and Russians belong together. And he may sincerely believe that, but the destruction of Ukrainian culture is really quite wanton.
I'm curious, Angela, about whatever you have to say about the reports now that the Germans have discovered a Russian agent buried within their intelligence service, which is troubling, although there's some history to it. I assume we don't know exactly what's going on, but what do you make of the reports?
Well, the reports that I've seen say that this individual was involved with signals intelligence, a very sensitive part of intelligence collection, and that obviously the United States has ties with all of its major European and other allies in this area too, and it's possible that this person had access to information that came from the United States. Again, it's all speculation. That's what's been at least leaked to the media, but it could be extremely serious because we don't know what it is that the Russians were able to glean from this spy.
And finally, Angela, take us into 2023 if we could. I mean, none of us has a crystal ball, but what will you be looking for that could really shift the pattern in this war one way or the other in this, what Vladimir Zelensky has said is a turning point in the war?
Right. So first of all, I will be looking at continued Western support, U.S. and European support, whether that is still there. I'll be looking to see whether there's a new Russian offensive in the spring, because the Ukrainians think that there might well be, that the Russians are training their mobilized soldiers. I'll be looking, obviously, to see how well the Ukrainians are doing, particularly with the new weapons, whether they're able to continue to push Russia back. And then I'll be looking at the domestic situation in Russia to see whether there is more public opposition to the war, which there really hasn't been that much until now because so many people who oppose the war have left. So I'll be looking at those internal dynamics. And then obviously the continuing impact of sanctions and whether ordinary people are going to feel them more going into 2023 than they did in 2022.
It's fascinating. Thank you so much. It's always so informative when we talk with you, Angela. That's Angela Stent of the Brookings Institution. And now, to keep you up to date on news from all around the world, we welcome now Lisa Mateo here with the first word.
Thank you, David. Well, in Israel, Benjamin Netanyahu has been sworn in once more as prime minister. That comes after a vote in parliament approving his political return after 18 months in opposition. This will be Netanyahu's sixth term as head of government. The coalition brings together his Likud party with ultra-Orthodox and religious factions. China says it's up to the U.S. to take steps toward resuming military talks that were suspended after Nancy Pelosi visited Taiwan. At a briefing in Beijing, a spokesman with the country's defense ministry said the U.S. can't expect discussions to continue while constantly harming China's interests. Tensions remain as Washington supports Taiwan militarily, and Beijing has pledged to bring the island under control. Meanwhile, Taiwan's semiconductor manufacturing has kicked off mass production of next-generation chips. That ensures the island remains the center of a critical technology that's fought over by the U.S. and China. TSMC is the primary chip maker for Apple. And it was one of the more significant disruptions to Twitter since Elon Musk took over the service. The platform has restored service hours after thousands of users worldwide reported glitches and other issues. Musk said Twitter had rolled out changes to its server architecture. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg. David.
Thank you so much, Lisa. Well, many of us are celebrating the holidays right now. We think we might get a vacation from politics, but it's not to happen. There's still politics going on. First of all, we have a new Congress coming in next week, starting next week. A lot of questions about exactly what the Republicans have in mind with their new narrow majority over in the House. We'll get a sense of what might be on the agenda with Bloomberg political contributors Jeannie Shanzano and Rick Davis. We're also going to ask them about the continuing saga of George Santos, that Republican who's just been elected from Long Island to Congress. Every day there's a new disclosure about something that he did not report accurately, including a remarkable interview that was done on Fox just last night. We're going to talk to our political contributors about all of that and much more, including whether we're going to get that debt ceiling taken care of in the new Congress, with the Republicans threatening to hold it hostage to some of the things that they would like to get accomplished. All that's coming up with our political roundtable of Rick Davis and Jeannie Shanzano coming up next on Bloomberg Balance of Power on Bloomberg Radio, Television and Radio.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. We are reconvening now our high-powered political roundtable right here on Balance of Power, and it includes, of course, political contributors Rick Davis of Stone Court Capital and Jeannie Shen Zeno of Iona University. So thanks for being back with us. Even though it's the holidays, there's a lot of stuff going on. But I thought one thing we might do is look ahead to next week. We're going to have a new Congress next week, as I understand it. Next Tuesday, they'll convene. And the question is what the Republicans want to try to get accomplished with their narrow majority in the House. So Rick, I'll start with you. What do you think is number one on their agenda?
Well, look, I mean, obviously, they've already started the process of investigating various conspiracy theories and Biden administration decisions. So I think that's got to be, you know, sort of the first thing that's going to come out of the box, because that's PR for them. They're going to make their base happy that they're going after the Biden administration. After that, you know, they're going to have some financial issues they got to tackle with, including the debt ceiling, which ought to be pretty interesting, a real test for whoever the speaker is. And I don't think we can assume at this stage it's going to be Kevin McCarthy. And then there are other issues like ESG that have become sort of a rallying cry on woke capitalism for Republicans. And there's no question that they're going to look into those things.
Yeah, and I think Rick hit the nail on the head. First thing, they got to get a speaker. The next thing, they're going to be focused on investigations. And this is what they have promised their constituencies, and they're going to focus on. And then, of course, the debt ceiling. And that is going to be something to watch because, of course, the financial implications, if they are unwilling to lift the debt ceiling, can be detrimental to all of us, to say the least. And then ESG, which is something, you know, they describe as, you know, woke liberal policies, you know, sort of inclined to destroy the fossil fuel industries. And we've seen the states really tackle this. Texas had a hearing just a few weeks ago. We saw Louisiana, we saw West Virginia, we saw Florida all pull money from BlackRock over ESG investing. And now we're seeing at the federal level that Republicans want to tackle this as well. And I think the real danger here is that they sort of, you know, diminish the companies, that big investors, from talking publicly about what they're doing in the ESG space. And so I know one of the things that we're hearing an awful lot from people who are supportive is that investors have to do a better job assuring the American public why ESG investing is important and why, if they don't tackle climate change, it can destroy us financially and the economy. And I think there is, you know, one bright spot may be that this, you know, sort of moves that conversation forward if they indeed at the federal level start investigating ESG investing.
Rick, you've been in and around the Republican Party for a long time. Tell us what you think about the move of the Republican Party. There was a day that I thought it was pro-business and sort of more let people alone, don't regulate them too much. And yet we have, particularly from the states, a lot of people saying, no, we're going to decide for you, the big funds, people like BlackRock, you shouldn't be taking ESG into account. Where does that come from? That seems very paternalistic. That doesn't seem very free market to me.
David, I think you're exactly right. I mean, here's a Republican Party that's made its history that they're less interventionist, right? Less regulation, let the markets do their thing. You know, the capital markets are the key. And here they are going after exactly that, what the capital markets are doing to try and accommodate the reality of climate change in everybody's lives and including the assets that people invest in. So it is an about face. It is really being generated by some of the harder right members of the Republican caucus. And there is a sort of sagebrush rebellion, to coin a Reagan phrase, where states are actually taking the lead on this. Attorneys general, Republicans attorneys general in a lot of states are going after these issues. I think they see them as sort of the new cultural divide, and that they can make some cheap political points. But when you start disinvesting in companies like BlackRock because it cares about proper corporate governance and a concern for whether or not climate is affecting the value of assets, you're really playing with dynamite when it comes to consistently supporting capital markets and a free enterprise system. So Republicans can't have it both ways, and this could actually hurt the party over the long haul.
So, Jeannie, I pick on you because you're a political scientist, and so I ask you exactly how this works. But come back to Kevin McCarthy. We don't know whether he's going to get it or not. Do you have a platform when you're running for it? Has he given us any indication of what he would do if he got to be Speaker? I mean, normally in a president, you kind of ask him that question.
Yeah, he has given certainly the Republicans an indication as to what they will do. They laid out a plan. He laid out a plan that he led in the fall. The problem is, in that time, as he has been squeezed in terms of his ability to be elected as Speaker, it turns out that he is pretty much, I think, going to have to give away everything in the kitchen sink in order to get these votes. And that includes not taking a stand on this, incoming Long Island congressman that we've been talking about, George Santos. I mean, the lies coming out of that, his resume are astounding. You have Republicans on Long Island and elsewhere saying, he's got to be investigated and prosecuted. And yet, since he agreed to vote for Kevin McCarthy, if he becomes, when he is sworn in on Tuesday, Kevin McCarthy really can't afford at this point to say anything. So he has remained silent. And that, I think, is an indication, if Kevin McCarthy is elected Speaker, what's going to be happening with him. He simply just doesn't have the ability to stand up and do what is in the best interest of either his party or the American public at this point, because he is beholden to people like George Santos now.
So Jeannie took us there, and as she should, and it's George Santos, which is the ongoing drama we're watching through this holiday season. And one aspect of it was an interview she gave on Fox, actually, with Tulsi Gabbard, who was sitting in, as I understand it, for Tucker Carlson. And it was on Tuesday night, I'm told, not last night. And this is part of the exchange.
We can debate my resume and how I worked with firms such as Goldman and Citigroup.
Is it debatable, or is it just false?
But,
is it debatable, or is it just
debatable.
false?
No, it's not false at all. It's debatable. I can sit down and explain to you what you can do in private equity, in capital intro, via servicing limited partners and general partners. And we can have this discussion that's going to go way above the American people's head. But that's not what I campaigned on. I campaigned on delivering results for the American people.
So, Rick, I have to say that, for me, encapsulates perhaps where we've gotten in this world. It's debatable whether I worked for Goldman Sachs or not. I mean, that most people think that's a known fact. Either you did or you didn't. They paid you, they didn't pay you. And he thinks it's debatable whether you worked for Goldman Sachs. Is this a larger indication of where we have devolved to in political discourse in this country?
Yeah, I think this is more to do with George Santos than the country at large. The country is all about, they want to know the truth, and they're fair, right? They're going to let him explain, but there's probably no explanation for the grandiose background that he built for himself that is really more fantasy than reality. I think George Santos's real problem is going to be follow the money. George Santos was broke a year ago and somehow was able to loan his campaign $700,000 that he, quote, earned in his new business incarnation. And just prior to this new business incarnation, he was working for a firm that wound up getting shut down for running a Ponzi scheme. So where did the money come from? He claims he's worth millions. He's going to have to explain to the authorities who are now launching investigations where he got that money. And it's better be a better explanation than he gave Tulsi Gabbard.
Yeah, it's a great point, Rick. Jeannie, I'll turn to you here. One thing that is typically not debatable for prosecutors is whether you violated the law or not. And now we have a state prosecutor and a federal prosecutor looking into just what Rick's talking about whether, in fact, there were federal statutes and state statutes violated.
That's right. I mean, you simply can't lie on these federal disclosures, and I think that's really where he is at risk and in hot water, potentially legally. Of course, he will be sworn in if nothing else changes in the next few days. He will be sworn in to the 118th Congress, and the people of the 3rd District in Long Island who were lied to during this campaign are being robbed. You know, you talk about his lies that he worked for the big banks. He was asking to be seated on the Financial Services Committee, and you had Kevin McCarthy shortly after he was elected celebrating his election and the fact that it was increasing the number of Jewish Republicans in Congress, which we now know is a lie. And so this is what the Republicans in Congress are going to have to deal with, and they cannot afford a special election in the 3rd District of New York. That is a Biden district. It'll be highly competitive, and they have such a narrow margin at this point. I think what they're going to try to do is hold out that he can vote for Kevin McCarthy and then hold out for 2 years and put somebody else up, because he's certainly going to face a tough battle if he decides to run again.
Rick, last word to you. I'm reassured that you think truth still matters in politics, but we do have Marjorie Taylor Greene coming out and defending him, saying, look, Joe Biden lies all the time.
Well, maybe Truth took a holiday in her district since she's been elected. But, yeah, you know, the American public cares about whether or not their representatives are lying to them. And I think that'll still hold true in this case.
Well, we can certainly hope so. Thank you so much. Great to have you with us always. As Rick Davis and Jeannie Shanzano, both political contributors for Bloomberg. Check out the Balance of Power newsletter on the terminal and online. Coming up in our second hour of Balance of Power, we'll hear from the former U.S. Special Representative for Ukraine, Kurt Volker. This is Bloomberg.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, you know, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, you know, this is something that, you know, many business leaders are focused on, and, you know, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and we'll continue to do so. We'll take a little bit of a margin compression on that, as we've had to, and I think that's the right thing, so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close. Welcome to Bloomberg Crypto.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. From the world of politics to the world of business, this is Balance of Power with David Weston.
From Bloomberg World Headquarters in New York to our television and radio audiences worldwide, welcome now to Balance of Power. Return now to a big story in 2022, which will be again in 2023, and that is, of course, the Russian invasion of Ukraine. What comes next? To take us through exactly where we are, we welcome now Kurt Volker. He's former U.S. Ambassador to NATO and former U.S. Special Representative for Ukraine. So, Mr. Ambassador, thank you so much for being with us. We hear various talk about talks. People have been suggesting, we had President Xi suggested of Mr. Medvedev. We've had various people say there should be talks. We've just heard from Mr. Lavrov, the foreign minister of Russia, who says no talks at this point. Are talks premature?
Yes, they are. Russia still has maximalist goals for taking over Ukraine, changing the government, seizing territory, claiming to annex some of it to Russia. These are going to be completely unacceptable to Ukraine and frankly, unacceptable to any standards of international law and order as well, too. So Russia's demands are far exceeding any reasonable basis for negotiations. What's interesting, however, is that Russia has set out these maximalist goals, but it doesn't have the military means to achieve them. They're actually losing ground on the battlefield. So there's this growing tension in the Russian position between what they say their intentions are, what they want to do, and what they're really able to achieve.
Well, indeed, we heard from Russia this week, Minister of Defense, I think, basically saying you should surrender. Why don't you just surrender right now, which seemed ironic given what's going on in the battlefield. But at the same time, as the Ukrainians make progress, and they are making progress, it's fairly incremental, is it not, and at great cost?
That's right. It is very incremental, and it is a great cost to the Ukrainians. It is also a great cost to the Russians. And the Russians have thrown more and more people into the front lines, a lot of casualties on the Russian sides. There was an estimate that the National Security Council spokesperson, John Kirby, put out last week, where he said that the Wagner group, this mercenary group that Russia hires to fight in eastern Ukraine, has 50,000 people fighting in and around Bakhmut right now. 40,000 of them are ex-convicts that were let out of jail to go to the front. So this is not a professional military. They're not well trained. They're not well motivated. And they're just getting pushed up to the front by the Russians. So despite the fact that they have numbers, doesn't necessarily mean they're going to have any more traction on the ground.
Do we have a sense, or do you have a sense, Mr. Ambassador, whether in fact Russia's put all their conscripts into the battle? Because I remember there was a large conscription that President Putin announced. Are those people in the battle now, or are they still coming?
Not all of them. Some of them have been pushed forward with very, very little training, maybe only a week of training. Others are receiving more training before going. And Putin is now, after that failed effort to get 300,000 people in a very public way into the military, they didn't get that number, and they drove about 1 million people to flee the country. Now they're more surreptitiously going about trying to recruit and push people into the military. That is producing modest results as well, and they're going to continue that. And just this past week as well, Putin made a few statements indicating that it's a war, and indicating that it's going to be a long war. Very different messaging from Putin compared to always calling it a special military operation and saying that everything is going swimmingly. So I think Russia's beginning to recognize that they're having some difficulties.
Is Russia in a better position to conduct a long war in Ukraine than Ukraine is?
I don't think so. The sanctions have really taken a bite in the Russian economy, particularly when it comes to spare parts and manufacturing. They're not able to produce and replace the equipment that's being destroyed in Ukraine. So they're having to go shopping elsewhere. They're going to Iran to get drones. They've gone to North Korea for basic military equipment. So I think their ability to resupply is going to be limited. Their ability to bring forces to the field who are trained and capable and motivated is already showing to be very limited. So they can continue fighting. No one is trying to take over Russia or destroy Russia as a country. So sustainability domestically is okay, but in terms of the military effort, they're going to have a very hard time. Ukrainians, on the other hand, they're fighting at home, so they have much better logistical supplies and support. They're getting tremendous support from the United States and other Western countries on the equipment side, on the training side. Their economy is also taking very big hits, but you have a lot of countries trying to step forward and help them out, including the European Union just this past year announcing 18 billion euros in budgetary support for next year. And that's on top of support that the U.S. and other countries are already pledging.
Mr. Messer, you mentioned earlier the horrific price that's being paid by the Ukrainian people, and we see it every day. We had a massive missile attack from Russia just overnight that hit Kyiv and other cities in Ukraine. What is the ability of Ukrainian people to withstand this as they lose power, they lose heat through the winter?
Yeah, it is remarkable how resilient the Ukrainian people are. And I think we forget, we're so used to the conveniences of power and heat and water and so forth. We forget that 200 years ago, nobody had these things. And that they managed to live through winters and wars and so forth. Not that it was ideal, but people can survive. And the Ukrainians are determined to continue fighting and go through these hardships rather than give up their lives and their territory or the lives of their countrymen. So they're gonna stick it out through this. You're absolutely right that it is devastating for the Ukrainian people. It's creating these hardships of power outages and temporary water outages, challenges to the energy system as a whole. And yet, I think that what it shows is Russia's not really able to win the war. They're doing this because they can't make the gains on the ground or hold the territory they've already taken. So they're doing these terrorist-style tactics to punish the Ukrainian population.
When President Zelensky came and gave that historic address to the joint meeting of Congress just before Christmas, he really emphasized that he believes 2023 will be a turning point in the war. I wonder how much it is within the power of the United States and NATO allies to help make that happen by really providing more support than we have in the past, which is something President Zelensky asked for.
Yes, I think we could be doing more, and I think it would make a difference if we did. Things such as helping them get or even providing ourselves tanks, aircraft, longer range artillery systems, short-to-ship missiles, things that are going to help the Ukrainians reach further, take out the Russian supply chains that are sustaining the forces in the field, and close off the Russian supply routes that are continuing to funnel equipment forward to the troops in the field. If they do that, and if we help them do that by giving them the equipment they need, I think it is going to strand a lot of Russian forces who are overextended. And I think that would actually speed up a decision by Russia to pull those forces back. If we don't do that, I think it's going to look like more of the same. Incremental progress by Ukraine on the ground while Russia bombs the cities.
Which raises the question, why aren't we doing that? Why is that not U.S. policy? Because time after time we've said we don't want to go that far, and then we end up going that far. For example, the Patriot missiles. We said, no, we don't want to give them to you. Now we're giving it to you. Why are we doing this in increments rather than saying, okay, if we give you all of what you've asked, as you said, fixed-wing aircraft, long-range missiles, more sophisticated tanks, why don't we just get there?
I completely agree with you, and I think that is what we should be doing. The rationale that the administration has, however, is that they don't want to change the image of this war from being one where it's Russia attacking Ukraine, Ukraine's defending itself, and we are showing restraint, to becoming an image of this being a NATO-Russia conflict or a U.S.-Russia conflict, where we are much more deeply involved. And so they set these arbitrary lines to say, well, we'll do this and we won't do that. And that will signal to the Russians that we're showing restraint and we're not being escalatory, we're not being provocative. I don't think this makes any sense, to be honest. The Russians already believe, and they say in their rhetoric, that this is really about fighting the U.S. and fighting the West anyway. They don't agree to Ukraine's existence as a state. They think it's only being propped up by the U.S. and the West. And they say, even in their rhetoric, that when they say they're willing to negotiate, they don't mean negotiate with Ukraine. They don't even think Ukraine has a right at the table. They want to negotiate with the U.S. and the West because they see this conflict in those terms already. So I don't think there's really any reason to be holding back on types of systems that we're giving the Ukrainians. The fundamental fact here is it still is Ukraine's country, Ukraine's sovereignty. They're willing to fight to defend themselves. And we can very easily help them do that by giving them the equipment without putting any U.S. troops or soldiers at risk.
And finally, Mr. Ambassador, let's come back to something you referred to. It's not just the military aspect of it. It's also the support for the budget. It's support for the infrastructure. Yeah. It's a lot of other assistance that Ukraine needs. Where are we on providing that? How much is it going to need?
Well, there are different layers to this. And the first is immediate humanitarian assistance, where a lot of organizations are providing things, sending them forward. It continues to be a need, but it is going very well. The second is the short-term aid, what you're saying, macro budgetary support, so that the Ukrainians can pay soldier salaries, they can pay pensions, they can keep the healthcare system going, those sorts of things, budgetary support. I'd say we're kind of at a yellow light on that right now. Pledges have been made by the EU, but not fully delivered. The U.S. has delivered a lot. There are still gaps. So there's progress here, but there's a little bit more that needs to be done. The big thing that is really urgent and necessary, and where I don't think we've seen enough progress yet, is structuring private sector investment possibilities, helping the Ukrainians reform the economy to the degree they need to, having sovereigns provide insurance guarantees for businesses so that if they take a risk and reinvest in Ukraine, that investment could be covered through some kind of insurance with a sovereign guarantee. Other things that might be usable and necessary to incentivize the private sector to invest. That will unleash massive flows of capital, and it'll be done on a sustainable business basis rather than a government handout basis. That's what really needs to happen to revive the Ukrainian economy. GDP has fallen between a third and a half this year because of the war. It is poised to bounce back when people start investing again. We have to get that process accelerated.
Mr. Ambassador, this has been a terrific summary and really analysis of what's going on in Ukraine. We really appreciate it. That's the Honorable Kurt Volker, former ambassador to NATO from the United States. Now, to keep you up to date with news from all around the world, here is First Word with Lisa Mateo.
Thank you, David. Well, a nonprofit that helps New York's homeless and HIV-positive population will add another line of business: marijuana. Today, the Housing Works will open New York State's first legal retail weed shop in Greenwich Village. The venture will face legal and illegal competition, as well as supply chain challenges. Housing Works is hoping for nearly $1 million in pre-tax revenue at the store in its first year. European health officials called restrictions on travelers from China unjustified. The European Center for Disease Prevention and Control said in an emailed statement that their health systems are equipped to handle the current load of infections. Beyond that, the center said the potential for imported infections is low compared to the level of COVID transmission already happening in the EU. Serbs in Kosovo began removing road barricades erected in protest against the largely ethnic Albanian government. The move comes after the U.S. and European Union increased pressure on both sides to avert a new Balkan conflict. Still, tensions remain as 2 trucks used to block roads were set on fire. That's according to tweets by Kosovo police. And in Israel, Benjamin Netanyahu has been sworn in once more as prime minister. That comes after a vote in parliament approving his political return after 18 months in opposition. This will be Netanyahu's 6th term as head of government. Coalition brings together his Likud party with ultra-Orthodox and religious factions. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg. David.
Thank you so much, Lisa. Well, I suspect there's some bankers out there, even on vacation, who are taking a look at what the regulation may be coming up next year. And we're going to turn to the Dean of Banking Regulation in the United States of America, Raj Cohen of Sullivan & Cromwell. He's going to take us through what he thinks banks should be expecting out of Washington in the new year. That's coming up next. This is Bloomberg.
From New York City.
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. I've made a promise to myself not to talk about Santa Claus, but the markets are up today. And so we have Abigail Doodle to take us through. She can talk about Santa Claus if she likes.
I can, and I guess I will, because we do actually have Santa in town right now. We do have a Santa Claus rally, the S&P 500, over the last 4 days, up about 0.7% on the day. It's all about today. The S&P 500 up 1.8%, that NASDAQ 100 up 2.4%. So big tech really outperforming this, of course, as yields fall. The 10-year yield down 7 basis points. It's not entirely clear. It had been backing up, David, but it could also have something, of course, to do with those jobless claims coming in a little bit weaker than expected, so yields down.
So I want you to take a victory lap here. Yesterday we talked about Tesla in some detail, and you were saying why you thought that maybe the fundamentals were supported a pretty high valuation, and look at what it's doing today.
Well, that's very kind, David. It's better to be lucky than right. I've learned many times, and the entry point for me for most taking a look at stories more in depth are the charts, and the charts, on this stock really, I mean, it is a little bit like catching a falling knife, but it does look like it has stabilized. It found support around 110. The RSI was the most overbought. Now it's not. But the fundamentals, the valuation, the story is actually better than it was yesterday. And I say that only because yesterday when I was talking about a 34 times PE, that was last year. So that's already in the bag. The forward is actually 24 times. When you put that relative to the S&P 500, 18 times, the 60% growth, it's really attractive. And then again, this is, I would say that it's just as much of a car company as it is a tech company. The ROE is excellent. The inventory turns seven times. Debt to equity, those are the metrics you want to look at car companies. They're really pretty solid. Adam Jonas over at Morgan Stanley took a notice and said this is going to see a re-rating, kind of what we were talking about yesterday.
I'll admit 24 times future earnings is getting into the realm of reality, which
Yes.
Tesla has not always been in.
Yes.
But at the same time, we had a year of tech really taking on the chin. And the question is, what comes next? Where is Apple these days?
Well, because Tesla is not the only one that's had such a hard year. Tech overall has had a very hard year, but Apple not as much, down 30%. But when you consider that it's the world's largest company, maybe you could say that it is a significant fall there. Now, this is a different story relative to valuation because they are looking at just single-digit growth on the sales, 2.7%, 1.6% on bottom. So if they have a miss, because we were talking yesterday about how there's a lot of wiggle room for Tesla, 60% growth this year, 56% next year, triple-digit growth on the bottom. But for Apple, they don't really have a lot of wiggle room. And take a look at this, David, 21 times, both forward and backward, only because there isn't really all that much growth. It is holding key support. If Apple holds 129, the beginning of next year could be nice. If not, it's going to be a tough year, not just for Apple, but the markets, because as goes Apple, so goes the market.
Sounds like they need a new phone to come out. Thank you so much to Abigail Doodle for that report on the markets. And now we want to turn to a really important issue for so many of our viewers, and that are the banks and how they get regulated down in Washington. And for that, we turn to the person who really is the dean of Washington regulatory law. He's Raj Cohen, senior chairman of Sullivan and Cromwell. Raj, thank you so much for being with us. Happy holidays to you. Let's look forward to next year and what you would anticipate for the banks. What is likely to come out of Washington? And let's start with the Treasury market, because there was a lot of talk about the Treasury market this year and whether it was, if not broken, at least being under some strain.
So, David, first of all, best of the holidays to you. I agree starting with treasuries is the right place because there is no element of our financial system which is as important. This is important to the U.S. as a world leader. It is important to the global economy generally because treasuries are the ultimate source of financial stability and strength. And as you correctly point out, there have been hiccups and maybe a bit worse than that in the treasury markets. So I would foresee a concerted effort by the government to try and shore up that market, make sure there's sufficient liquidity, and make sure there's sufficient stability.
So there are two issues there, at least that I hear, Raj. One is there enough liquidity? And it's a question of exactly who's holding the treasuries, how long are they holding for. Another is transparency, which is terribly important because, as I understand it, a fair amount of the market has moved out of the regulated banks and the broker-dealers into areas like hedge funds we may not know as much about.
Right. And those two terms, transparency and liquidity, I think are inextricably intertwined. The more transparency you have, the more liquidity I think you will ultimately have. And I think it would be the right approach to resist what I call the siren song of more regulation. But what there does need to be is more information and more disclosure. It doesn't have to be public disclosure, but the Treasury Department, the SEC, the Federal Reserve, they all need to know where those treasuries are held and where derivatives for those treasuries are held. The UK found out that if you don't quite understand where gilts are held, there's a potential problem, and we should learn from that experience with the pension plans there and really bolster the disclosure here.
What about the way that the trades are cleared? Do we need central clearing?
In my view, absolutely. That is the ultimate goal, should be the ultimate goal. Central clearing is not without its issues because you need to have backup mechanisms to make sure that if there are fails, what will happen. But a robust central clearing approach would make enormous sense for treasuries.
One of the things we've heard from a lot of the big banks throughout the year is the issue with leverage ratio and holding treasuries that is discouraging some banks from holding as many treasuries that may affect the functioning of the marketplace. Is the Fed likely to address that issue in the new year?
I really don't think so. And I think that's unfortunate because artificial constraints on the Treasury market work against the objective of liquidity. But I do believe all the banking agencies are steadfastly committed to a leverage ratio, which basically imposes a capital surcharge for holding